Welcome friends in this edition of live virtual classes for the paper Advanced Financial Management. I, C. Ashish Gupta, Joint Director Board of Studies, welcomes you all. Students, in this edition, as we are continuing our previous lectures, it is in a hybrid mode. We hope you must have completed the topic of foreign exchange exposure and risk management. Now, in today's session, our renowned faculty, CA Parvesh Aki sir, will complete this topic in a first part. In the second part, I myself shall take up the session on the international financial management. So I will revise the same. So today we shall go through, we shall finish both of these topics. So student, with this, now I request show to the Mr. CA Pravesh Agi sir. Now student, if you have any query, you can ask your query during the session as well as after the session. So, okay, Pravesh sir, now it's shown for you.
Sure. Okay, good morning, students. This is Pravesh Agi, a chartered accountant, and today we are going to cover the topic Advanced Financial Management, and these are the revisionary classes. And the topic which we are going to cover is foreign exchange exposure and risk management. So let's begin. So we have already covered some ground in the last 2 days back. And today we are going to talk about the currencies futures market, and then I'm going to talk about the forward market, and then the balance topics. So, this is the most important topics because most of the questions are in CA final are asked from these topics. So let's begin with the futures market. Now we'll do straight away. Delve into some questions which came into your CA exams. So the first question is there's a company called XYZ Limited, which is an export-oriented business house based in Mumbai. The company involves in customers' currency. The company invoices in customers' currency. So normally, the company will always invoice in the customer's currency. That's the most of the normal case scenario. So its receipt of US $1 lakh is due on 1st of September 2009, which means that there is an export. He has made an exports and he's going to receive $1 lakh on 1st of September 2009. And market information as on June 1, 2009 is given. That means probably we are somewhere in June 1st, 2009. And now this company XYZ is going to receive $1 lakh after 3 months. That is 1st of September 2009. Now some information is given to you. US dollar rates are given versus rupee both in the spot and forward market as well as in the futures market, that is through the stock exchange. Now the rates are, spot rate is given as 0.02140. Now what is this rate? This is an indirect quote. As I told you, normally we are accustomed to currently the rate is 83 rupees around for $1, but this is just a reciprocal indirect quote of dollar in India. So where we are saying that $1 is equal to so many, $1 rupee is equal to so many dollars, 0.02140. And in the 1 month forward, the rate is 0.02136, and 3 month forward rate is 0.02127. Okay, so the 3 months forward rate is given, which will be more relevant for us. Okay, the spot rate is also given, and 1 month forward, which is not able to use that because the money is going to receive on 1st of September. So 3 months forward rate will become a valid rate. Similarly, the US dollar versus rupee contract size, which is given as rupees 4,72,000. So this is the contract size, one lot. Now, normally in India, the National Stock Exchange, the rate is, the lot size is $1,000. Now this is given in terms of rupees, which is 4,72,000. Now the June contract is available at 0.012126 and September contract is available at 0.02118. Normally, the stock exchange will give you 12 monthly contracts and some weekly contracts, and you have to choose the relevant contract. So in this case, because you're going to receive the money in September, so the September rate becomes more important. So for that, the rate is that 1 rupee is equal to 0.02118. Okay. Now, and before you enter into the trade, you have to pay a margin. Okay. So that is, that rate has been given as for June, it is given as 10,000 rupees. So that means you have to give a margin of 10,000 if you are entering into a June contract. But here we are entering into September contract. So we have to pay 15,000 rupees upfront to enter into futures contract. And the interest rates are also given because that is 7.5% and 8% because your money is going to be blocked for 3 months, and the initial margin will get released only when the contract is over. So that means there is a loss of interest. So that means 8% is the kind of a interest which is given. Okay. So XYZ Limited is an export oriented. So this is what we have done, and then I have marked the things which are in red. The September contract, 3 months contract, and initial margin. So let's begin with the further. On September 1st, 2009, the spot rate, that means after the 3 months are over, in actual sense, what happened was on September 1st, 2009, the spot rate for US dollar versus rupee was 0.02133. So this was the actual happening on 1st of September. And the currency future rate is 0.02134. Normally the rates are same in the real world, but here in the question it is given that the future rate is slightly different than the spot rate prevailing on that day, because it's a RBI reference rate which is generally picked up by the stock exchange to settle the transactions. But here the currency future rate is given to you, which is 0.02134. Comment which of the following methods would be the most advantageous for the company XYZ: using the forward rate, using the currency futures rate, or not hedging the currency risk. So basically, we have to choose out of these three which the company should use, because they are going to export. So wherever we are getting the higher amount, we will be choosing that contract. Suppose we are getting more in the forward contract, we'll say the forward contract is better. Suppose the future happens to be the better one out of the three, then we'll say the future contract inflow is higher, so we'll be choosing the futures contract. But if you not hedging currency works risk, taking that not hedging your currency risk works out to be the better option, then we'll say that we don't have to take any forward contract or currency futures. We can go for not hedging the contract. So let's see. Now, it may be assumed that the variation margin would be settled on the maturity of the futures contract. So that means whatever margin you have paid, 15,000 rupees per contract, this will be settled only at the end. So that means you're losing some interest on blocking the amount for that period. So and that amount needs to be adjusted according to arrive at the decision what we have to take. So let's go for the first option, which is a forward rate option. Okay, receipts using a forward rate contract. Now we know that the 3 months forward rate is given to you. That is 1 rupee is equal to so many dollars. Now what we can do is we can simply look at the amount what the company is going to receive. That is $1 lakh. So they are going to give the delivery of $1 lakh to the bank, and bank is going to give them 47 lakhs 1,457 rupees, which is basically because it's an indirect quote. So here we need to divide $1 lakh with this thing 0.02127. If it had been direct, we would have multiplied, but here we have to make a division. So we know that if we just see by dividing, we get the rate as 47 rupees 101. So these rates are somewhere in 2009 when the dollar was equivalent to 47. Okay, so you'll get this amount. Okay, so if you want to again check, in terms of rupees, what is the rate quote? It was 47. We multiplied with 47.01 with 1 lakh, we got the same amount. Okay, so either we can just divide, or we can make a reciprocal and work out the direct quote and multiply by $1 lakh with the direct quote, we'll get the same amount. So this is when we use the forward rate contract. That means we entered into a forward contract with the bank, and that we will be receiving some money after 3 months, and the bank is going to if they take a forward rate contract, and then the amount which is expected to be received at the end of 3 months will be 47 lakh 1,000. Now let's talk about using the currency futures option. So please listen to it carefully, because this is a little bit tricky one. So the number of September contracts. Now, since the lot size is given to you, lot size is 4,72,000, which we have seen. So what we'll do, we'll look at the September rate. Okay, because we are interested in September and not in June or July. So we will take the amount of exposure, that is $1 lakh, and divide it by the currency rate, which is the 0.02118. So that means the total exposure in terms of the September contract will come out to be 47 lakh 20,000, the total exposure. And if we divide it by lot size, okay, because in stock exchange we have to take a position in lots. Okay, So normally we will not, either will be overhedged or underhedged, because we'll not be able to cover entire amount. But in this case, for a very simple reason, the contract have been kept as 10 contract. That means, so neither we are overhedged nor underhedged. We are absolutely in a proper hedging position. 47,20,000 divided by one lot size will give you 10 contracts. Okay, so that means we have to take a position in 10 contracts. That means we have to take a futures position in September month. So initial margin, what we need to pay is upfront for 10 contracts. For one contract, it was 15,000. For 10 contracts, it will come to 1,50,000. Normally, now if you are an exporter in this case, so normally you take a short position in dollars. Okay, because you have a a long position in your export real transaction, so you will take just the opposite position, that is take a short position in dollars as an exporter. But since the quotes are indirect, so that means we have to take a long position in INR. Okay, so because all the contracts have been defined in indirect position, so we'll be taking a long position in INR. So that means we'll take a long position. We'll take a bullish position that the rupee for 10 lots at 0.02118. In case if the the rate of the rupee increases over the period of time, we make money. Okay, so that means when the rupee is going, so the dollar is coming down, so we are losing actually in our export position, but this position in currency futures will give you a kind of a profit. Okay, so it will get offset with your real position. So I'll explain that later. So on September 1st, the position will close at 0.02134. That is given the question that on September the future is trading at 0.01. That this is the the rate at the expiry. So when you begin and took a long position, the rate for September was 0.0118. Now that means the rupee has appreciated, which means the dollar has depreciated, and you are an exporter, so you're going to lose money. But here, because since you have taken a long position in rupee and the rupee has appreciated, so you're going to make money. Okay, so he makes a gain of how much? 2134 minus 2118. So that gives you a $0.00016 per rupee the contract. So that means this much of money you're going to gain in this contract. Okay, per contract. So for 10 contracts, which are equivalent to 4,72,000 per contract, so which will work out to $755.2. So this is your gain which you have made in the futures transaction. Okay, because you have just taken the opposite position, though you are losing because the dollar is depreciating or the rupee is appreciating, you're losing in your actual position. Okay, because you will be getting less money when you go to the bank and convert your money into dollars, but converting the money into rupees. So here you are making a gain. So this gain is going to offset your losses. Okay, so let's talk about, so gain in the spot in rupees at the spot rate will be because the spot transit rate is given. That means at the end of 3 months, that is September, when you go to the bank, the stock exchange will give you 35,406 rupees. Okay, this is the money which you will be getting from the stock exchange, because the stock exchange, the transactions are cash settled. You won't get dollars from there, okay, or any other currency. So you're not going to get any, currency there, but you will going to get a cash settlement. If you make a gain, you will get money in rupees. If you lose the contract, then you make a loss, then you will be getting, you have to make the payment to the other party via the stock exchange. So in this case, the other party who has taken the opposite position than you, he is going to give you 35,000 via the stock exchange. So you are going to get 35,406 from the stock exchange. Okay. Now let's see what will happen in September. First of all, the margin will get released. So whatever money you paid, to the stock exchange for 3 months, which was like 1,50,000 rupees, 15,000 rupees per contract at 8%. Okay, is the rate of interest. So that means you are going to, though you are going to get the margin back, but 3,000 rupees will be your total cost on interest outlay. So now what will happen? So this is your cost. This is what you have lost by taking this contract, and you have gained 35,000. Now, when you get 1 lakh rupees from your exporter on the date of 1st September, you will go to the bank, and bank is going to, give you the money at the spot rate prevailing on that date. So that spot rate is given to you. So bank is going to give you 46,88,233 rupees. So this is the money which you are going to get from the bank. But And now, if you want to know, what was the, your net receipts. So you got 46 lakh 88,000, but you gained because the rupee, has appreciated and the dollar has depreciated. So you have lost the money in your real transaction, but that will get compensated by 35,406 from the stock exchange minus the 3,000 because you have taken a bet for 3 months, you have deposited a margin. So there's an interest opportunity cost. So let's deduct that. And the final outcome will be that you'll be receiving 47 lakh 20,639. So now we have received the money as per forward contract we have seen how much we'll be receiving as per the currency futures. Now we move on to basically receipts under different methods. So two methods we have already done. Third is not hedging. So forward contract, we are receiving 47 lakh 1,000. Futures contract, we are getting 47 lakh 20,000. Okay. So that means 47 lakh 20,000 much higher than the forward. So we should go for the futures. But before we make a decision, let's see what happens on unhedged position. Now, the spot rate prevailing at the expiry was 2.0213. So which means that you will be getting 46 lakh 88,000 if you have not hedged yourself. So most advantages is futures contract. I hope you have followed. So if you have any query, please let me know. But if you have not followed, there is another question which I'll be doing, which is of almost similar type. Okay, so that if you have missed out something, you will be able to, come to know in that context. So I'm not going to repeat this again because there is almost a similar question which is coming up now. So we have the second question. So I'll just pause a bit. If you have any query, please let me know so that we can tackle it by second question. So chat, I'll just see the chat if suppose there is any. So good morning. What is a contract size? So the average market. So now what is a contract size? Now, when you are going, you have options, like you have multiple options, like, forward contract, futures contract. Let's talk about them. So when you go to the forward to the contract with a bank, so forward contract, generally you take a forward cover with the help of a bank. Okay. So there is no contract size. Fine. So you can, there's any amount of, exposure, whether you're an exporter or an importer. So it is going to, suppose I say, if your exposure is, say 1,000, let's take a very small amount. If your exposure is say $1,200, okay, you go to the bank and say that I want to take a forward contract for $1,200, whether it's for export or import, it is immaterial. So bank will say, okay, fine. But of course, the bank will always look for a very high amount, but I'm taking a small amount just to give you an example. So bank will, hedge you for those $1,200. So they will give you a rate. So that means you're going to pay this amount if you're an importer at that rate after, say, the period is over for the contract. That means suppose it is 3-month contract. So they will honor that money. If you're an exporter, then you're going to receive at that forward contract rate for $1,200. But when you go to the stock exchange, the story is different. There, the lot size is $1,000. For dollars, it is $1,000. For euros also, it's $1,000. And for pounds also, it is $1,000. Only for yen, it is about $1 lakh. So in case of, dollar, the lot size is $1,000. So if you go to the stock exchange, but your exposure is for $1,200. So that means you have to enter into only one lot or for two lot. If you go for one lot, you are under hedged. If you go for two lots, because you can't take for $1,200 in the stock exchange, because stock exchanges are markets which have fixed standards. Okay, you can't deviate from them. Okay, so they are fixed that the contract size has to be $1,000 in a multiple of $1,000. So even if your exposure is not matching in terms of $1,000, so that means you will be like in this case, my example, your exposure is $1,200. So if you take 1,000 one lot and take a bet, that means you are underhedged. But if you take a $200, then you are, grossly overhedged. So you have to decide, which way you want to go. Suppose you can live with the underhedged, you can take underhedged position and take a position in 1,000 lots. I hope it is clear. Okay. Right? Is that clear, Mr. Mankat? Okay. So in stock exchange, everything is basically standardized. Okay, so let's move on to the second exercise. Okay, so export limited and export oriented unit invoices in currency of the importer. It is expecting, now there's a company called Export Limited, which is export-oriented unit, invoices in currency of the importer. Normally, that is the case because we always invoice in a foreign currency and not in rupees. I mean, of course, in the recent past, there have been cases where you're allowed to raise an invoice in your own currencies, provided your customer also accepts. So it is expecting a receipt of 2,40,000 US dollars on 1st August 2022 for the goods exported on 1st May 2022. So that means, you have a exposure of 2,40,000 US dollars, and you are an exporter. Now, in case if the dollar, appreciates, so then you don't have to cover yourself because, you're expecting the dollar to go up, then you're going to make money. Apart from your profit on your, imports, you are going to also make money if the dollar also, goes up. But in case if the dollar goes down or the dollar depreciates, you're going to lose. So you don't want that. Okay. So we don't know because what will happen in the next couple of months because the markets are very uncertain. So it is always better to forget about the gains and losses occurring from the foreign exchange fluctuations, but rather to go and take a cover because you want to make your profit from your real export transaction and not to try to make money from the the movements of the foreign currency. So it is always prudent to take a risk cover either through a forward contract or to the futures contract or money market hedge. So it is expecting to receive 2,40,000 when on 1st of August. And what is the date now? 1st of May. So the following information is available on 1st May 2022. Okay, so this is the current situation. The spot rate is also given, USD versus INR. And again, these are all indirect quotes. 1 month forward contract is given, 3 months forward contract is given. I made them red because the money is going to receive only after 3 months. So the red rates are more relevant for you. Okay, fine. Similarly, in case of the currency futures contract also, it will be July contract, which is relevant for you. Okay, because you're going to receive the money on 1st of August. So July contract is the nearest one. So you're going to take a position in July. And the contract size is 6,40,000. Now, before you enter into a contract, the stock exchange has fixed a margin. That means you have to pay a certain margin. Okay, so that's a deposit which you have to give to the stock exchange. So that stock exchange will ensure that there is a risk-free trade and there is no counterparty, loss appearing on each of the parties. So they will going to take a money. And apart from that, there is something called mark-to-market, kind of settlement every day, so that the transactions are foolproof and nobody, loses on account of non-performance of the other party's side is obligation. Okay, of course you will make a loss because of your own transaction, but not because if there is other party, is not able to honor the contract. So for that, the stock exchange generally fixes a margin, as well as there is something called mark-to-market settlement. So every day, the settlement will happen where you will get a gain or loss, depending upon which way the contract is moving. So in this case, initial margin, May was 15,000, August is 26,000, and interest rate in India is 9% and 8.5% in August. So for us, the most relevant position will be that you have to pay 26,000 as initial margin, and rate will be 8.5% with the rate of interest. Now, how come the May is 15,000 and August is 26,000? You may ask, why there is such a variation? Now, it all depends upon how volatile is the currency pair. Based on that, the initial margins are decided. So maybe some transactions are happening, a lot of transactions happening in August, or there is a lot of volatility which the stock exchange is viewing in the month of August. So they have jacked up the initial margin for August. It's not because of the time, but it is because of the volatility witnessed in August trade, which has which the stock exchange has jacked up the margin for that. Okay. So on 1st August 2022, the spot rate USD versus INR is 0.0126 and the currency future rate is 0.0125. So the spot rate, that means the rate at the real rates, that is the spot rate after the contract 3 months is 0.0126. And the currency, this is the rate at which you're going to receive money from the bank, okay, if you are an exporter. But if you're an importer, then this is the money you have to pay. and currency future rates are 0.0125. So this is the rate at which the contract with the forex with the stock exchange is going to be settled. Normally, the stock exchanges take the RBI reference rate as on the last working day of the futures contract. So normally the spot rate and the currency future rates are almost similar or the same, but there can be some differences. So in this case, there's a difference of 0.0001 paisa per dollar. Okay, suggest suitable approach to export limited that would be most advantageous out of the following methods: forward contract, currency futures, no hedging. So we have to choose whether the company should take a forward contract, whether the company should take futures contract, or company should not hedge at all. Now, it will all depend, where you're getting the most of the money. You're an exporter, the money where you're getting the most, inflow of in terms of rupees highest will be the contract which will be choosing. Okay, so whether it comes in forward contract or it comes in futures contract and no hedge, so it will, let's see, wait for that. So whatever will be the highest, we'll choose go for that. So assume that the variation in margin would be settled on the maturity of the futures contract. So generally, the margin is always settled. You'll get your margin back only at the end of the settlement. That means whatever initial margin you have paid, I think 25,000 rupees in this case per contract, you will get this amount only at the end. Okay, apart from the profit or loss, which the profit you will be getting and loss you have to pay. Okay, and the maturity and the margin will be separately settled. So let's talk about the first case. Receipt using the forward contract. So it is expecting a receipt of USD 2,40,000 on 1st of August 2022 for the goods exported on 1st of May 2022. So it is expecting a receipt of 2,40,000 on which date? On 1st August 22 for the goods which are exported on 1st of May. So the exchange rate, 3 months forward rate, that means you went to the bank and took a forward contract. Suppose you had done that, you would have received your money at one rupee is equal to so many dollars. So if you make a division, because this is an indirect code, so 2,40,000, because that means 1 rupee is equal to so many dollars, but you are going to get your money in dollars. So either convert this rate into from indirect to direct and then multiply, or simply make a division, you'll get the same answer. Okay, so that means here you will be getting 1,95,12,195 rupees. So this is the amount that you'll be getting if you have booked a forward contract. Now, before you book, you have to just see the other two cases also, okay, and find out which is a better one. So let's talk about using currency futures. So the number of contracts needed is USD 2,40,000. So that means this is the amount of dollars what we are going to get, and the contract size per dollar is 0.0125 divided by the rupee. The lot size, which is 6 lakhs. So that means exactly 30 contracts you have to take a position, either a long position or a short position, depends upon what you are. And the initial margin for 30 contracts will be, for each contract, it is 26,000. Okay, so that means you have to pay 7,80,000 as the margin, the money which will be blocked for 3 months. Okay. Now, first will be you are going to take a buy position, buy futures. Why? Because the rates are in indirect rates, so you're going to take a long position. Normally, as an exporter, you have to take a short position, but short position can be only in dollars in this case, because you're exposed to dollars. But here you are exposed, your exposure is in turn an indirect operation, which is in rupees. So you're going to take a buy futures. Okay. So which will give you the same result. So buy futures on 1st of May 2022, 30 contracts at the rate of 1.00125, which is the September contract rate. Okay. If you go back and see the question, the rate is 0.0215. Okay. So let's go and check that. So the rate was July, if you just focus at 0.0125, this was the rate. Okay. So when you took a position, fine. So when you took a position, it was 0.125. But what happened to the spot rate and the currency future rate on 1st of August? It was 0.0125. Now the rate has not moved at all. When you took the position, it was 0.0125. When you closed your position, it was also 0.0125. So neither you made a loss nor you made a gain by taking any position in the futures contract. So let's get and see that. So you bought futures, you took a long position. Okay, fine, in the rupee. So because if the rupee would have gone up, that means the dollar would have depreciated. So you would have made a loss. Okay, so that would have if the rupee would have moved up, so you would have made a loss, made a gain basically in the forward in the futures contract. Okay, so that would have been better for you because you would have lost in your real transaction. So that would have offset your losses in the real position versus the stock market position. So, but in this case, the stock market has not moved at all, and the position has remained as it is. So on 1st of August, the rate for 30 contract, the rate was 0.0125. So you haven't made any money in the futures contract, but you're lost because of the margin, the interest, the opportunity cost. So no profit or loss in the futures position. The exporter is going to receive, rupees. How much rupees they're going to receive? 1 crore 90 lakhs 47,000. Because then the exporter will receive $240,000 at the end of 3 months from the customer. The customer. You will go to the bank and give the delivery of $240,000 and take a rupee. And the rupee rate is 0.0126, which is the rate, the spot rate on that date. So let's go and check the spot rate again to make sure that we have taken the right one. So here the rate is on 1st of August 2022. The spot rate is 0.0126. Now, this is the rate at which the bank is going to convert your dollars into rupees and give your money in your account. Okay, so you have got this money. So here the stock exchange is not at all involved. You're going to receive money from your banker. But what will happen from this thing? So your net inflow is 1 crore 90 lakhs. So what will happen in the stock exchange? In the stock exchange, neither you have gained nor you are lost, but still you are losing because you have deposited 7,80,000 there, and at 8.5%, which is the opportunity cost of the money which you have blocked for 3 months. So you will count this loss on account of 16,575. So net inflow after considering the interest on margin will be 1 crore 90 lakh 47,619 minus the interest cost, okay, which is 16,575. So that means you're going to get 1 crore 90 lakhs 31,000. So net, this is your kind of a inflow. Now let's talk about no hedge position. In no hedge position, you're going to, the stock exchange rate on 1st of August, we know is 0.0126. Okay, fine. So this is the rate which is given for the bankers are giving you this money. So you would have got 1 crore 90 lakhs 47,619 rupees from the bank if you have not taken any hedge and you waited for the period to be over without taking a hedge. You would have got this money. So let's now compare. So this is the rate which is given on the stock exchange. So let's see, compare which is the better. Forward contract is better. Forward contract you're getting 1 crore 95 lakhs. Futures contract you're getting 1 crore 90 lakhs 29,000. No hedge, you're getting 1 crore 90 lakh 47,000. So out of that, the maximum money which you're getting is a forward contract on your exports. So clearly, the forward contract is a winner. So you should go and take a forward contract. Now, all these numbers are not available at the time when you're taking a contract, because if everything is uncertain. But only on the hindsight, if you know what is going to happen, you're going to take a decision that the forward contract was a better option. Okay. Had you taken a futures, you would have lost money. Had you taken a no hedge, you would have lost money. So you should have gone for forward contract. So here you're going to make a forward contract. So that means most advantageous position is forward contracts. Okay. So let's see if you have followed. If you have any questions, please let me know. Okay. So you have any chat line and let me know. For deciding the lot size, which rate is to be taken? Current spot? Oh, no, Mr. Mankad, the rate has to be taken as the rate as for that particular month. Okay. The rate, I told you the stock exchange will give you 12 monthly contracts. If you're choosing a monthly contract, so that monthly contract rate at which you have taken, the position, so that will be decided for the lot size. Okay. Fine. So let's go back and see here. So let's see what we have taken. So let's see the second question. Okay. Okay. So this was the second question. Okay. Fine. Okay. So now, what we have taken is, in this case, the following information is available. So 0.25. Okay. So let's look at this rate. Okay. And then when we arrived at the number of the contract size on the futures market, we have taken 0.25. Okay. So this is the number of contract needed. So we have taken the relevant contract for that particular month, the rate prevailing on that particular day to decide about the contract size. So if you take even the first question, because in this case, both rates are same. Okay. The spot rate as well as the rate at the for the contract. But in this first example, the rates were different. So this way you will get a better handle. Okay. Let's go to the first question. So the first question where, the rate is September rate is how much? Look at the middle one, 0.02118. Okay. So this is the September rate. Okay. So now when you enter the contract, you should have taken this. Okay. So see 2118. Okay. This is the September rate. Okay. Whereas the close rate was 0.2134. So we haven't taken this rate. We have taken 211, which was a September rate. Now, mind you, this is the rate which was prevailing at the time when you are entering the contract. Okay. Now, this rate for the September contract will keep changing after every second. When you are, taking a position on that very relevant time, whatever rate which is prevailing at the rate which you have taken a position will become the rate for deciding the lot size. Will decide about the total number of lots which you have to take. Okay. If the rate goes up, then the lot size can vary. It will all depends the time when you're taking a contract on the stock exchange. Suppose today, for example, we are in the month of June, and you're going to receive your money in the month of December. You're an exporter. So you go to the December contract and see what is the last traded rate for December. So there will be a last traded rate. Suppose it happens to be 84 rupees, 1 paisa. Okay. So you are going to decide about, the number of contract based on that 84 rupees, 1 paisa. So that means what is the total exposure? That means how much dollars you are going to receive. You are going to divide by 84.01 based on December contract. But if you don't take this thing and you wait and next day you go again to the stock market and say that I have to book for the December contract, suppose the rate goes to 84.5 paisa. So then in that case, it will be the contract will be decided on the rate of 84.5 because the rate keeps changing. And the rate relevant will be the rate for a month in which you are going to take your, position. Okay. Now in stock exchange, there are monthly contracts as well as there are weekly contracts. For a certain first 2 or 3 months, the weekly contracts are also there. So you can take a position either on the weekly contracts or a monthly contract, depending on which is more beneficial for you or which is more relevant for you. So the rate prevailing at that time becomes your rate at which you should be, taking for deciding the total number of lots you need to take a position. I hope you have followed now. Since you should have some practical, kind of exposure to understand it much better, but I have given you the feel of that. Okay. So, okay. So I hope you have followed. Okay. Fine. So let me see on a chat line if there is any question. So no question. I think most of the people are asking questions on this thing. So this was which we have finished. So it's good, Mr. Mankad, you have asked this question, and this is that you are listening it properly, and you have a very genuine queries, and I appreciate your ultimately interest in the topic, and this will go a long way in helping you to improve yourself in terms of understanding this very complicated topic. So let's move on to the next question now. So this we have done. Okay. So now we go to another question. So some of the questions, there are about, I think, 3 or 4 questions which we are doing on similar lines. So by the time you will be able to make out what a whole gamut of these contracts. Okay. So let's do another exercise. So ZAD PLC, a UK company, is in process of negotiating an order amounting to euro 2.8 million with a large German retailer on 6 months credit. So that means there's a company, which is a UK company. They are going to, make an exports to a German company. Okay. And German company is going to pay them money after 6 months. And the total amount of the exposure or the export order is going to be worth 2.8 million US dollars. If successful, this will be the first time for ZAD has made export goods into highly competitive German market. Okay. So for this company, this is the first big order. Okay. So ZAD is considering following three alternatives for managing the transaction risk before the order is finalized. Mr. Peter, the marketing head, has suggested that in order to remove transaction risk completely, ZAZ should invoice the German firm in sterling using the current euro pound average spot rate to calculate the invoice. So there's a guy, Mr. Peter, in the company who's a marketing head. He suggests that we should not take any risk, foreign exchange currency risk. Let's pass it on to our customer. Okay, and we should raise our invoice in our home currency, which is pound. And he has suggested we should take the average spot rate. Okay, both the bid and ask average. So he says that we should take this amount average and raise our invoice on that basis. So this is his suggestion. But there is another guy who's Mr. Wilson, who is the chief executive, happens to be the boss of the company, is doubtful about Mr. Peter's proposal because he understands that the company may not accept, the German company may not accept that the exposure should remain on their shoulders, rather it should remain on the shoulders of the exporting company, okay, ZAZ. So he says that suggestion an alternative of invoicing German firm in euros. So he says that we'll go for invoicing in euros and let's take the risk and using the forward exchange contract to hedge the transaction risk. He says let's go and take a forward contract, okay, which will be more acceptable to our exporter. Our company, our customer. So Miss Karen, CFO, is agreed with the proposal of Mr. Wilson to invoice the German first in euros, but she's of the opinion that ZAZ should use sufficient 6 months sterling further contracts. So that means she's talking about futures contracts. So in England, we may call them sterling further contract. Now, of course, we have pounds. Earlier they used to be sterlings. Okay, so now we call them pounds. So these say that we should take future contracts in sterling to the nearest whole number. Okay, fine. So she's saying to the nearest whole number because there's always a lot size. As I told you, there will be either you're over, hedged or under hedged. So you should be taking the nearest whole number. So she's also giving that we should not be the nearest whole number should be decided for taking the position and to how many lots we should take up to hedge the transaction risk. So now the forward rates are given as this thing. So the forward data is given, which is let me just check this. Okay, the forward data is available. The spot rate is 1.1960. So this happens to be the bid rate and ask is 1.19. Now the exposure is actually in euros, but the rate is given as, in an indirect quote. That means 1 pound is equal to so many euros. So rather we should have the euro rate, but anyway, we will deal with it. So the 6 months forward rate is 0.60-0.55 euro cents. Now we understand when the rates are given like this, when the swap points are decreasing in order, then the relevant currency is in the forward market is available at discount. Normally it will be like 55.60, so which will mean that the pound is trading at a premium, but in this case the pound is trading at a discount compared to euro. So the 6 months forward point is suggesting that. Okay, 6 months further contract, which is the futures contracts currently trading at 1.1943 per pound. Okay. And the 6 months future contract size is 62,500 pounds. Fine. So this will be only relevant when we do the the futures contract. After 6 months, the spot rate and future rate is also given, which is the same. As I told you, normally they are the same. There can be sometimes differences. So as we have seen in the previous questions, there are some differences. So here also the rate is given. Okay, the date on which you are actually going to receive your money. Okay, fine. The banks are going to give the money. Okay, so let's talk about, so calculate to the nearest uh, pound, the pound receipts for ZAS PLC under each of the three proposals. In your opinion, which alternative you should consider to be the most appropriate? So let's see whether it is the average rate, that means the invoicing raised in pound sterlings, or in terms of the forward contract or the futures contract. So we have to find which one is the better one. So invoice the German firm in sterling using the current euro pound average spot rate. Now, we used to call them sterling in our old era, but now we call them pounds. Okay, so you must remember that. So, in proposal of Mr. Peter, the spot rate is 1.1960, 1.1970. Okay, so this is the rate which is given, and the average spot rate would be basically, taking the average of the two. Fine. So the rate, average spot rate will be actually adding the both bid and ask and dividing by two. So rate comes to 1.19. So invoicing in pound will produce how much? 2.8 million euros divided by 1.1965, because here the rate is given in indirect code. So this rate is 1 pound is equal to so many this thing. So that means we have to make a divide to calculate and convert them into pounds. Okay, fine. So 2.8 divided by 1.1965. So this is the amount of pounds that the company is going to receive. So this is the amount which the company is interested in. So whichever the option which the company is going to get the most will be relevant. So I'll just make it highlight a big one. So this is the most relevant number, okay, for us to take a decision. Okay, so I've just made it a little highlighted. So this is 2.340 is under the first option, if this is acceptable to the German firm. Now we go to the using the forward exchange contract to hedge the transaction risk. Proposal of Mr. Wilson, who is the CEO of the company, chief executive. So the forward rate we know is given as we have to calculate the forward rate. So forward rate, since we know that the pound is trading at a discount to in the futures contract, so we have to minus here. Otherwise, if it would have been premium, we would have added to arrive at the forward rate. So we took the rate and using the forward market hedge would be as follows. So the rate is, now we have arrived the forward rate. How we have arrived? So let's see. The spot rate is given to us. If you look at the data which is appearing outside the boxes, the spot rate is 1 pound is given as spot 1.1960, 1.1970, and 6 months forward points are given 60 and 55. So what we do is that we just minus from both the sides, bid and ask. Look at the bottom of the screen. But here we will be most interested in basically in the first one, which is the bid. Okay, because you are going to get your money and you are going to go to the bank, and bank is going to convert your money at the bid rate. Okay, so which is more relevant for the exporter. So it is going to be 1.1 divided by 1.195. So you're going to get 2.35 million. Now, so this is more important here. Okay, so if you use a forward contract, so you're going to get your money in a million, which is given to you here. Okay, fine. So if you just save it and then you just look at both the options. So here you're getting 2.35. But in case of an average rate, the rate was how much? It was 2.34. Okay, so in a forward contract, you're getting 2.35. So so far, the forward contract seems to be a better option. Okay, let's go to now, before you take a decision, let's see what is in the futures options, futures trading. ZAS should use sufficient 6 months sterling for the contracts to the nearest whole number to hedge the transaction risk. So this is what the CFO has said. So this is the proposal of Ms. Karen, who says that we should take the futures contract. The equivalent sterling of the order placed based on future contract would be this. So rate which is given to us is 1.1943. So this is the future trade prevailing on that month. 6 months trade rate. Okay, so let's go and check this for our understanding. So what rate we have taken? So 6 months for the contract is trading at 1.1943. So the moment you went to the stock exchange, you saw that after 6 months, the future rate which was trading at that point of time was 1.943. Assuming that you have taken a bet on this rate, then you should take this rate for deciding the lots, how many lots you're going to trade. Okay, fine. It may keep changing, but suppose this is the rate at which you have locked your this thing yourself. So you're going to take this. Okay. So let's go back and see. So you took 1.1943. So $2.8 million is the total exposure divided by 1.1943. Why we are doing it? To decide how much is the exposure in terms of pounds, because the lot size is given in terms of pounds. So now when you divide this with a lot size in pounds, so you get to the nearest contract of is close to about 37 contracts. So that means the figure is not exactly 37, which is a little more or less, but the nearest to the whole number would be 37 contracts. So let's see, if you multiply 37 with 62,000, that means you are a little bit under hedged, which means you are covering yourself only for 23,12,500, leaving the balance unhedged. Okay, fine. So 23,12,500. Normally, now what will happen is that when you go to the futures market, so either you will be overhedged or underhedged, but as per the proposal given by the CFO, we have to do it at the nearest of the whole number. So in this case, you are slightly underhedged. Okay, 23,12,000, whereas the total number of exposure was 23,44,000. Okay, fine. So roughly about, I think, 25,000 or what, 22,000 pounds you are underhedged. Normally, you would take a short position in euros. Since you are an exporter, okay, you're long in euros because you're going to get money from your customer in your real. So you should take an opposite position in the stock market. That means you will going to take a short position in euros. But since the quotes are indirect, so you'll have the same, kind of, this thing effect if he takes a long position in pound. So because the long position in pound is equivalent to a short position in euros. So since the quotes are given in pounds, so that's why we have to take a long position in pounds. We can't take a position, short position in euros, unless the rates are given in direct manner. So we have to take a long position. So buy futures. So that means you're going to take a long position in pounds. So you're going to buy futures because 1 pound is equal to 1.943. So you buy a future. So that means if the pound appreciates, you're going to make money. Okay. But in your real transaction, you're going to lose because, you're going to get less money from your bankers. Okay. Whereas now what happens at the time of close at the expiry? You've taken a long position in pound, but the pound has actually depreciated. Okay, so the rate was 1.1873 at the time of export, at the time of future rate, closing at the expiry. Now we can go back and check this rate again. Let's see. So after 6 months, the rate, the spot and the future rate, which is identical. Okay, here, the rate at which the bankers are going to give the money, as well as the stock settlement, which is going to happen in the future market, is the same, 1.187. Okay, so let me just put my having some battery issue. Okay, so let's go back. So the rate was 1.1873. So when you took a long position, the rate was 1.19. So the pound, you took a long position in a pound, 1.19, because here, whereas at the close at the expiry, it was 1.1873. That means you're losing money. Okay. So you do the difference of the two, 1.87, 1.1873 minus 1.1943. So you'll find the difference is 0.0070. Okay. So the total loss on the future contract would be 37 multiplied by 62,500 into 0.0070. So the loss in terms of euros, fine, because you're losing the money in terms of euros, which is 0.0070. Okay, so 37 contracts, and for one contract was 62,500. So you're losing 16,188. Now, after 6 months, what will happen? So this is the money which you have lost in the futures market. Okay, so the amount which you're going to receive will be 28 lakh euros or 2.8 million euros loss, less loss on the futures contract, which is 16,188. So that means you're going to get now 27 lakhs 83,812 euros. Okay. So selling receipt on sale of euros at the spot rate. Now we are spot rate we have given. So we'll convert this money. The bankers are going to give you the loss will be converted by the stock exchange, and you will get money from you have to give it to the stock exchange there. But your total amount which you're going to receive from your exporter will be converted at the spot rate because the future rate is the same. Okay, at the close of the futures contract. So you are going to get the rate is 1.1873. So you are going to convert these euros at the spot rate prevailing at the end of the contract, which is 1.1873. So that means you're going to get 23 lakhs 44,627. Now here we have both clubbed the loss which you are making, which is 68,118, and 28 lakhs which you are going to receive from your customer, and the net total amount which you're going to get is 27 lakh 83,000. Now this needs to be converted into pounds. At what rate? The spot rate prevailing at the end of the contract, so which is 1.1873. So the money which you're going to get is 23 lakh 40,000. So if you want to convert that into million, so it will be 2.345. So this is a very important amount here, because now you're going to compare this amount with the others. So let's talk about, let's see where you're getting the better one. So proposal A, 2.34. So this was, I think, the average rate. Proposal B, which was the forward, and proposal C, which was the futures contract. So, proposal of option B is preferable because the option A and C produces least receipt. So it is the forward contract which seems to be a better one. Further, in case of proposal A, there must be a doubt whether this would be acceptable to German firm, as it is described as a competitive market, and that is moving into the first time. So both, because this is the first time when this company is moving into the big export market. So very unknown in the export markets, German firm will not take that risk. So they will ask Israel to take. The exposure should remain in basically in their own currency, which is euros, rather than taking into the pounds. And so invoicing in pounds will be ruled out by the German firm. Okay, so this is what we have done. So let me see if there is any kind of a query on you. So let's see. So I think I have got some. So I have not got any query, I think. So surprising. So Mr. Mankad, if you're there, or anyone else who's watching it live my lecture, so if you have anything to ask, please do ask. Okay. Okay, yeah, I think I got one. Not now, sir. Okay, good. So you can just go through my videos, and because these are complicated ones, so there would be many questions. So you can ask them at the end of the session if you want. Okay. So now we go to the currency options, the most trickiest one. Okay, fine. So let's do one question here. So the first question, so we are going to talk about. So XYZ Limited, a US firm, will need 3 lakh pounds in 180 days. In this connection, the following information is available. So in this case, the company is a US company. Okay. So X Limited is a US firm. They are going to need 3 lakh pounds. So that means they're going to import something in UK market, and they will be needing 3 lakh pounds. After how many days? After 180 days. Now, the spot rate, which is given as £1 is equal to $2. Good. So 180 days forward rate is given as pound will be 1.196 pounds. So this is a great news for the company, because if company has an exposure, they have to make 3 lakh pounds payment, and the spot rate was $2. So that means they would have needed for immediate payment 6 lakhs dollars, but now they'll be receiving less in 180 days time. So the forward rate is telling you that the pound is depreciating, and this is going well for the company. Anyway, this is just my observation. Interest rate are as follows. 180 days deposit rate is 4.5% for UK, and it's 5% for US. And 180 days borrowing rate is 5% in UK and 5.55% in US. A call option on pound that expires on 180 days has an exercise price of 1.97 and a premium of 0.04. Now, so this question may involve, going into the options market as well. Now, this company has an exposure of 3 lakh pounds. Okay. So they are going to, make a payment in 3 lakh pounds. Okay. After 180 days. So in their real position, they are short of pounds because they need pounds. They don't have pounds now, and they'll be needing the pounds from the bankers. So in the stock market, they have to take an opposite position. So that means they have to take a long position. So a long position is equal to a call position, a call option. A put option will be a short position. A call option will be taken generally by a importer, and a put option will be taken by an exporter if the quotations are direct. But if the quotations are indirect, the reverse is going to happen. But in this case, the quotations are given in direct manner because the pound rate is given in terms of dollars, and that is what we need. Okay, so this is a direct position. A call option will be the most relevant one here. So you will be taking a long position in pounds. A call option on pound that expires in 180 days has an exercise price. Now you have to choose the exercise price. Now, in this case, the exercise price has been given to you, only one exercise price. Now, generally, the stock exchange will give you various exercise prices, and you have to choose one. But since there is no choice in the question, the exercise price is 1.97. Okay, so which means that if you choose this exercise price, you have to pay a relevant premium along with it. Okay, so it is 0.04. So if you add the exercise price with the pound, so it will come to 2.01, which means if the rate goes beyond 2.01, you're going to make money in the stock exchange. But if the money goes down to below 2.01, then you're going to make a loss. But if it goes down below 1.97, you're not going to exercise the option at all. Okay, fine. So only you will exercise the option when you are making money. So if it is 1.98, you're recovering 1.01 of dollar for the premium, but you're still not making any gain. You're losing 0.03. But beyond 2.01, you're going to make money. Okay, fine. So let's begin with that. XYZ Limited has forecasted the spot rate 180 days hence below. So the rates which they have forecasted is, that this is kind of the rate which are going to be there after the 180 days. So 1.19, 25% probability. 1.95, 60% of the probability, and 2.05, 15% of probability. Okay, so this is the kind of future rates which are going to be there, which has been forecasted by the company. Which of the following strategies should be most preferable to the XYZ Limited? Okay. A forward contract, a money market hedge, an options contract, no hedging. Show calculations in each case. Definitely, we'll be showing that. So first, let's talk about the forward contract, which is the most simplest one. So forward contract, dollar needed in 180 days. So we have 3 lakh pounds multiplied by $1.96 is the rate in the forward contract. So that means the first option will actually amount to outflow of 5,88,000 pounds from your company. Okay, so this is the first option. Let's go to the second option. So the rate which is given as 1.96. So we have used the rate, same rate. In a money market hedge, what will happen to the money market hedge? So let's talk about that. In case of imports, the money has to flow abroad. In case of imports, the money has to flow abroad. We know that here you are an importer and the money you have to pay. You are in USA and you have to make money in pounds. Okay. So borrow in US and invest in UK. So you need to first borrow. So you have to preempt everything first. So you borrow in US. So that means the money is going abroad and you have to put that money in UK. Borrow in dollars, which is the home currency, and then you shift that money in UK and convert them into pounds and invest that money in pounds there. Convert the dollars into pounds at the spot rate prevailing at that time. Invest in pounds so that the amount grows to pay off the pound liability. So convert the dollars into pounds at the spot rate and invest the pounds so that whatever money we have to pay abroad, which is $3 lakh, you can invest in pounds so that the amount grows to pay off the amount. So you convert that into invest in pounds so that the amount grows to pay off the pound liability. Okay. Then because you have a liability in pound, isn't it? Because you have 3 lakh pounds to make a payment. Okay. So you're going to invest in pounds. Home currency loan repayment, principal plus interest becomes the cost of import. So this is the whole gamut of money market. So let's do all the steps one by one. Money market hedge, borrow dollars, convert to pound, invest pounds, and repay dollar loan in 100 days. So this is all you have to do. Okay. Amount in pound to be invested. So now you need to make an investment abroad. You are a US based company and your exposure lies in pounds in England. So you have to put your money in England. So if you deposit the money in England, you are getting 4.5%. Okay, fine. That is the deposit rate. So how much you should deposit today so that the amount grows to 3 lakh pound, which will be sufficient to repay your pound liability. Okay, so fine. So this is the amount will be 2,87,000. Fine. Now what we'll do, the next step will be since you have amount. So this money you are going to borrow, amount of dollar needed to convert. So that means you need this much of money. Okay. So you convert this into at the spot rate, which is 2. So you will get 5,74,000. So bring this money back to your own home country and you borrow this amount. Okay. Sorry, you are going to borrow this amount in your home country, not bringing back. This is the money you need to borrow. Interest and principal on loan after 180 days will be 5,74,000 because the interest rate when you borrow money in USA, you have to borrow 5,74,000. So a correction there, you don't have to bring the money, but this money you have to borrow in America. Okay. So when you borrow this money in America and you give this money, take this money outside and then invest. Okay, it will be 2,87,000, which will grow to 3 lakh pounds, which will be sufficient to pay your pound liability. But since you have borrowed this money in America, you have to pay interest on that. So which will be 5.5. So that means the total amount in terms of dollars outflow will be 6,05,740. So let's compare this with the forward transaction. It's 588. Here it's coming to 6 lakhs. So that means the forward contract is better because the outflow is less. You're an importer. So as an importer, you should be paying least. Okay. So the forward contract seems to be better. So I'll just repeat this a little bit more crisply. So what we have done is basically, first you need to, borrow some money. The first step would be you should borrow some money in US. Okay. For that, you need to do a back calculation, which means, first of all, you should know how much money you're going to invest in pounds. So the amount which you're going to invest in pound is 2,87,081, which when you invest it will give you the full amount of 3 lakh pounds, which will be sufficient to pay off your pound liability. Since you have to, you need 2,87,000 pounds, but you don't have that money. Where you're going to borrow from your home currency. So how much you're going to borrow? $5,74,162 because the rate is 2 in the spot market. So this money you need to borrow in America. When you borrow in America, in dollars, you have to borrow 5,74,000. For how many? 180 days. So when you have to settle the loan amount, you have to pay an interest. So the borrowing rate in America is 5.5%. That means you have to pay ultimately $6,05,741. So this is your total outflow. Okay, so this is the number which you are looking for. This is your net end result of money market transaction. So you have to pay 6,05,000. Now let's move on to this is the spot rate was we have used $1 for amount to be needed in dollar, and the interest rate and the borrowing rate and the interest rates are coming on your screen. So we have used these rates. Okay. Now we come to the call option. The third one, okay, a call option on pound that expires in 180 days has an exercise price of 1.97 and a premium of 0.04. So I told you that the exercise price is given by the stock exchange, and there are various exercise prices, array of exercise prices which are thrown on you by the stock exchange. And the relevant premium is also given with respect to each exercise price. And you have to choose. Now, there will be options which will be in the money. There will be options which will be out of the money. And deep in the money will cost you the most. Deep out of the money will cost you the least. Okay. So normally you should always take, close to the money or at the money options where the premiums are quite reasonable. So let's assume that they have taken in the money, close to the money option, which is $1.97, which is having a premium. So if you're going to exercise this option, call option is a bullish position in terms of pounds. If the pound goes up, you make money. If the pound goes down, you lose money. But the pound has to cross a threshold of 1.97 before it starts making money for you. But since you have paid a premium of 0.04, so you'll start making money only a profit only after 1.97 plus 0.04, which is 2.01. Okay. But any move above 1.97 will cover your premium bit. So you're going to exercise the option only if it crosses 1.97. But if the option falls below 1.97, the rate falls below 1.97, the actual rate, then you're going to just simply walk out of the contract and lose the premium. Okay. You're not going to make any gain in the stock exchange. But maybe when you walk out of the contract, you don't exercise your opposition. It may be good in your real transaction. Okay, because then you're gaining in the actual market. But anyway, so let's talk about expected spot rate in 180. So let's take now, since the rate is not given on the settlement date, so we have to choose the expected rates. Now, suppose the rate was 1.91. The spot rate after 180 days was 1.91. You paid a premium of 0.04. So the first option is that you're not going to exercise an option because it is well below 1.97. You're not going to make any money. So you're not interested. So you'll simply walk out of the contract, but your total cost will be 1.95. Why? Because 0.04 will be your loss, which you're have to give to the stock exchange. The person who has taken exercise, you have taken a call option. So the call option buyer will pay 0.04 premium to the call writer. So that is a cost. And the money at the end of 180 days will be 1.191. So that means the total amount in terms of pounds, for 3 lakh pound, the total, outflow on that particular day will be 5,85,000 multiplied by 25% chances that you will be paying 1,46,250. Okay, which means that on that day, on the last day, if the spot price, the real spot price came to 1.91, then you're not going to exercise your option. What you're going to lose? $0.04 per per contract. Okay, and you're going to get your money from the bank at 1.9. So, which means the total outflow which your company is going to experience will be 1.91, 1.95. When you translate them into pounds, it comes to 5,85,000. Since the probability of this happening is 25%, so that means the outflow, expected outflow will be 1,46,250. I hope you have understood. Now, let's say if the exercise price, if the spot rate happens to be 1.95 on after 180 days. Okay, the rate given by the markets, okay, the interbank market or the merchant rate, 1.95. Now, since the rate is 1.95, the exercise is 1.97, still you're not interested because it has not moved beyond 1.97. So you are in a losing position in your betting, the call option. So you're not going to exercise it, but you're going to lose your premium. The premium you have paid to the writer. The writer is going to make the money, and the person who has bought the option, as you are the person who has bought the option, your company is going to lose $4 per pound. So this money is going to be lost. So that means the total outflow which you are going to experience will be 1.99. When you convert that into pounds, it will be 5,97,000 pounds. And there is a 60% of probability that happening. So that means your total outflow, expected outflow will be 3,58,200. Now, the third scenario where the expected price is 2.05. Now, this is good news for you from the stock market perspective. You are making a gain, but your gain will be, pruned down to 2.01 because the 4 paisa is basically your premium which you are paying. Okay, so that means you're actually sitting at a gain 2.05 minus 1.97 minus 0.04, which will give you a figure of 2.01. So that means the total price per unit will be 2.01. So we have shown a calculation here. Okay, so we can just see at the bottom. So it is, the gain in the option contract. Look at that bottom. 2.05 is the price at the end of the 180 days, minus the strike price, which is 1.97, minus the premium which you have paid to enter the contract, 0.04. So the gain of the contract will be 0.04. So the net outflow will be 2.05, which actually, is the rate that particular day. So that means this is the money which you have to pay to your banker. Okay, and then 4 paisa gain which you are making from the stock exchange will offset your total outflow and make the outflow to 2.01. Okay, so that means your total price per pound will be 6,03,000, and there is a 15% probability of that happening. So that means your total outflow will be 90,450. So if you add them up, the expected outflow will be 5,94,900. Before we do that, you have to add a premium, because since you're paying a premium to the writer, okay, so the cost of that is the rate of interest, because you're taking this happening at 5.5% is the interest rate in America. So that cost you should take for $12,000, because the premium which you're paying will be $12,000. It will be 3 lakh. Will be the total pound multiplied by 0.04 is the dollar per pound is the premium. So that means the total premium will be 12,000 pounds, $12,000, and this money will be blocked for 180 days. So you have to calculate the cost, which comes to $660, dollars. So your total outflow will be 5,95,560. Okay. So now we know all the scenarios. So gain. So we have all the scenarios. Now, of course, the one more scenario is left, which is no hedge strategy. Now here we have to take you basically all the rates, the future expected rates, which is 1.91, 1.95, and 2.05. And there's a probability attached to each one of them. So you first convert that into pounds, okay, by dividing the figure. 3 lakh divided by 1.9, so you'll get 5,73,000. Or sorry, 3 lakh multiplied by 1.9. So you'll get, because it's a direct quote, you don't have to make a division. So you will get a 25% probability is that you will get 1,43,250 is a total expected outflow. Then 60% the total expected outflow will be 3,51,000, and 15% probability the total outflow will be 92,250. So total expected outflow will be 5,86,500. So which means no strategy appears to be the most preferred because the least number of the dollar needed as per the option is to arrange 3 lakh dollars. So now we can just look at all the options. Forward contract, you are getting 5,88,000. So if we divide this by the pounds, then the rate per pound is 1.96. Money market options, you were actually, the outflow was 6,05,000. So per pound, the total hit is $2.02. Currency options, it is 5,95,000. It works out to be 1.98. No hedge, it comes to be 5,86,000. So 1.955. So if we compare all of them, we find the no hedge options to be the cheapest, where you're paying only 5,86,000, and the rate per pound is also the lowest. So this completes the options. Okay. So no hedge strategy appears to be the most preferable because the least number of dollar needed under the options to arrange pounds. So after the break, we'll be talking about fate of forward contract. So we'll have about a short break, about 5 to 7 minutes, and then we will, reassemble after that and complete the two chapters, which is the forward contracts and the Nostro and Vostro accounts. Okay. So we have a break for about a few minutes. Okay. Okay. Welcome back. So we had covered a question on the options. Now we are going to yet another topic which is called fate of forward contracts. Now normally we always when we go for forward contracts with the bank, there can be various kind of scenarios which are applicable there. So let's talk about them. Whenever any forward contract is entered, normally it meets the following three fates. Okay, so there will be delivery under the contract. That means if you are an importer, then you are going to get dollars. You have to take dollars, okay, from the bank because you have ordered for dollars. Say 3 months contract. Suppose you entered into the bank, and the bank will say now the 3 months are over. Please take the delivery of the dollars and pay us in terms of rupee. So this is the normal case, delivery of the contract. Now it can be even case of an exports. When you have to take now in case of imports you have to take the delivery, but in case of exports you have to give the delivery because now you have got the dollars with you from your customers. When I say dollar, it means any other currency, whether it's a euro, yen, or whatever. So for simplicity's sake, I'm referring dollar as one currency. So either you take a delivery of dollars or you give the delivery of dollars. If you are an exporter, you got the dollars from abroad. So you have to give the delivery of dollars to the bank. So these are the two kinds of scenarios which are there, delivery under the contract. Second is that you don't need now the foreign currency or the dollars because of, maybe whatever reasons that your contracts are cancelled, your order is not postponed or whatever. So you cancel the contract. You don't require now. Since you have booked a forward contract for buying dollars or for selling dollars, so you don't need it because your order is no more, or you have changed, your positions have changed. Your order has been postponed or preponed, whatever can be reason, you have to cancel the contract.
प्रवेश सर,
Third, yeah.
आई थिंक आपने वो स्लाइड खोल ली क्या?
अच्छा एक सेकंड, योर
देयर इज इशू, मतलब आपका वो आ रहा है, बॉक्स आ रहा है जहाँ पे आपका फोल्डर है, बट आई
अच्छा
थिंक
अच्छा okay, so I have to share I think okay new
no,
share.
it's okay. No, it's okay.
It's okay.
Just revise. If have you skipped any slides, so please repeat it, sir.
No, I have not. I mean, skipped, and this is the first slide.
Okay.
So I'll just yeah. Okay.
Okay, sir. Thank you. Okay.
Okay. So we are going to talk about fate of forward contracts. Thanks for that, Ashish. So fate of forward contracts. So normally, as I just repeated a little because the slides were not there on your screen. So, fate of forward contracts, which means that you have entered into a forward contract with the bank to, for buying dollars or for selling dollars. If you're an importer, you buy dollars. If you're an exporter, you're going to get dollars from your customers and you're going to give the delivery dollars to the bank. So you enter into a forward contract. Okay. When I say dollars, I mean any other currency. Okay. So there can be first a delivery under the contract. The first kind of a most happening situation will be delivery under the contract. So if you are an importer, you have to take the delivery. If you are an exporter, you have to give the delivery when you get the dollars. Now, it may happen that you have need to cancel the contract because either there is a delay in your actual international trade. So you first cancel the contract. Okay, fine. So or the contract is not at all there. So you have booked a contract. Now you need to cancel. You don't require it. The third would be there is a delay and you want to extend the contract. Okay, fine. So these are the three kind of situations which can be there in case you take a forward contract with a bank. Okay, so now it can be delivery under the due date. Now delivery on due date. So it can be you actually the most common one, 90% of the cases or more than that will fall under this category, delivery on due date. That means the due date comes, you are an importer, so you have booked dollars, so you have to take the delivery dollars and pay Indian rupees to the banker, or it can be an exporter where you give the delivery to the banker at the rate fixed under the forward contract, okay, and you will get the money in Indian rupees. Then there can be early delivery. A situation where sometimes it may happen that if you are an exporter, then you have to getting your dollars much earlier than what it was envisaged by you earlier. So you go to the bank and say that I'm going to getting the dollars earlier. So please take the delivery at an earlier date. rather than on the due date. So that can be one scenario. The third would be the late delivery. So, if the delivery happens later, then it can be the reverse case of early delivery. Okay. Then the third kind of a scenario can be cancellation on the due date. That means on the due date, you just went to the bank and say, please cancel our contract because I don't require it. Because, the whole contract, international trade is not there, happening for you, and you came to know quite late, almost at the time when on the due date. So you went on the due date. And early cancellation, you came much earlier to know that you don't require the contract. So you can go for an early cancellation or late cancellation. You don't, came to know quite late, your contract was already there and the date has already gone by, and you went to the bank and say, sorry, I don't need a contract. So it can be a late cancellation. So similarly for extension, it can be extension on the due date. So that means on the due date itself, you went to the bank and said, sorry, I'm not getting my dollars on the due date. Suppose you're an exporter, you're going to get them, say, 1 month later. Or it can be for an import, you have to make a payment after the date on which you have agreed with your supplier. So you're going to make the payment after the contract was entered. So you are going to extend your contract anyway, both as an exporter and importer. So there can be an early extension. I mean, you can approach to the banker much earlier than the date on the due date, or you can be a late, you go for the bank much later because you came to know about much later that you may need an extension. Okay. So all possible situations, 3 situations, and all combinations about 9. Okay. So they can be. Now let's understand some of the scenarios address them through our practical questions. Okay. The first, so I just check a chat line. I think in this question, though, the rate is direct by long position. Please explain again. Okay. Okay. So we have moved on to the next chapter, but in this question, though the rate is direct, why a long position? Please explain. Explain. And okay, I remember that question where the question was that the person was exposed in pounds. Okay. And he was an American company, and the rates are given direct. Okay, fine. So you are basically an importer. Okay, importer in America, exporting goods from UK, and you have an exposure in pounds. Okay. Now, as an importer, if you look at the real position, you have to make money payment in pounds, but you don't have them right now. You don't have the money with you in pounds. You have in your own home currency, which is dollar in this case. So you are short in pounds. Okay. So whatever position you have in your real underlying position, you have to take just the opposite position in the market if the quotes are direct. So in this case, you take a long position in pounds. Okay. So that you have a hedge. Why you have a hedge? Because if you take a long position, that means if the pound goes up, you're going to make money in the stock exchange. Okay. Whereas you're going to lose the money in your real position, where you're actually you have to make a payment in pounds. If the pound goes up, that means you have to make a higher money. Okay. As an importer, you have to make more pounds. Okay, so that means you're losing in your real underlying position, but in the stock market, you're gaining on the other hand by taking the opposite position. So it creates a perfect hedge. So any gain in the stock market will hedge the losses in the real market. So to have this, kind of a scenario, so you have to take an opposite position in the stock market if the quotations are direct. Okay, so that means in this case, you're making a loss. You were making a gain in the long position. So this was offsetting your real position, and ultimately you were perfectly hedged. Okay, I hope you have followed, but you can again raise this question if you have not followed at the end when we are going to have a session. Okay, fine. So now let's talk about an exercise here. Or you just watch again and again what I have said and try to see how it fits into the question. Okay, so you will realize that. So this is the most important one, the question which you talked about, and the most relevant one and most people don't understand that so easily. Okay, it's the most complicated one. But if you apply your mind, you will be able to understand. You can raise this question at the end of the session again. I'll try to again explain. By the time, just digest what I have told. Okay. So now let's come to a question here. Just forget about that at the moment and just focus on the forward contracts at the moment, and we can just talk about your query at the end of the session. You as a banker has entered into a 3 months forward contract with your customer. So you as a banker, now you're talking about in respect of your banker, has entered into a 3 months forward contract with your customer. Okay. So that means you as a customer have taken a contract for 3 months forward contract. Okay. To purchase Australian dollars 1 lakh at the rate of rupees 47.2500. So as a banker, you have entered into a forward contract to purchase Australian dollars 1 lakh. And what is the rate? 47.25. Who is your customer? He is an exporter, because he is going to get $1 lakh after 3 months. And as a banker, you're going to purchase those dollars at 47.25. So you have purchased, whereas your customer has sold. Okay. So the customer has sold $1 lakh to you. So he has entered into a sale agreement and you have entered into a purchase agreement, which is looking from both the sides. However, after 2 months, your customer comes to you and requests for cancellation of the contract. So now your customer doesn't need the contract. So he comes after 2 months, he says, I don't need. So please, cancel my contract. On this date, the quotation for Australian dollar in the market is as follows. Rupees 47.30 oblique 3500 Australian dollars. Okay. 1 month forward rate is given as 47.45 and 52. So now, okay, determine the cancellation charges payable by the customer. Okay. Now here, if you look, your customer has actually sold the Australian dollars to you. Okay. To cancel the contract, now he has to purchase the same very Australian dollars. So he has to buy. Okay. Now he has to buy because the contract was 3 months. So he has to buy, and 2 months has already gone by. So he has to, buy 1 month forward. Okay. So for that, the ask rate will be relevant, which is 47.5200. So let's talk about and see. So customer entered into a 3 months forward contract to sell Australian dollar. He's a customer. So he, entered into a 3 months forward contract to sell Australian dollars, which is 47.25, which is given the question. So we don't have to apply our mind at all. Now, after 2 months, your customer comes to you and requests for cancellation of the contract. Now, 1 month forward contract is given to you. Okay. So customer buys. Now, since you have sold, to cancel the contract, you have to buy 1 month forward contract. It has to be synchronized with your earlier contract. 2 months have already gone by. So 1 month forward contract is also given. Forget the spot rate on that day. Look at the 1 month forward contract. If you look at the question here, the spot rate is given after 2 months. So that is not relevant for you. The relevant rate is 1 month forward. So 1 month is still remaining. So the contract has to be cancelled along with on the day on which, because you've taken a 3 months contract, so 1 month is still remain. So you have to choose the 1 month forward contract to cancel your contract. Okay. So here, customer buys 1 month forward contract to buy Australian dollars. So those the things will happen the same day and your contract will get cancelled. Okay. So that's the logic. So here, there we took the rate as 47.45. Okay. Because this is the bid rate. Okay. Because he's going to buy. Okay. First he has sold. Now he's buying. So bid rate is applicable to you and not the ask rate. So he's going to choose the bid rate, which is 47.52 to cancel the contract. So the customer has first sold. Now he has bought. He sold at 47.25. He bought it at 47.52. So net resulted, there is a loss to the customer. Okay. He bought it at, look at from this angle, he buys at 47.52, sells at 47.25. That means he's making a loss of 0.27 per Australian dollar, which means the total cancellation charges payable by the customer will be 27,000. Okay. Let me just, I think the screen is closed. Okay. Can you see my screen now? Okay. So there is
Yes,
one.
sir, it is visible.
It is visible. Okay.
But just make it on a presentation mode. Just
I'll do that. I'll do that.
yeah.
I know that it is not on our presentation. I can see that.
Please.
So I'm just doing that. Okay, I'm just doing it. I'm not able to find my cursor, so that's the issue. So some issue with my laptop, I believe. Okay. So here it is. Okay, fine. So the total cancellation charges payable by the customer will be 27,000 rupees. Okay, I hope you have followed. So in case you are not followed, look at this question, which is identical question, but in case of here, only the Australian dollars have moved on to US dollars. Okay, so just have a look at this question and try to find the answer yourself. Okay, I'll give you just a couple of minutes. Do it at yourself. Okay. So here I'll just read the question. You as a banker has entered into 3 months forward contract with your customer. Identical, okay. To purchase US dollar 1 lakh at the rate of 83.25. So however, after 2 months, your customer comes to you and requests for cancellation of the contract. On the date of quotation, on this date, quotation for USD in the market is as follows. 1 month forward rate is given, spot rate is given to you. Determine the cancellation charges. Okay, just tell me what will be the relevant rate which we should be taking. The question is, Mr. Mankad or anybody who's listening to me, what should be the relevant rate at which the contract will be cancelled? Will it be the spot rate or will it be 1 month forward rate? Number one. Second, if it is any of the two, whether it will be bid rate or ask rate. My question is that. That's all. Okay. Just do the calculations and let me know. And I look at the chat screen also later on. First, I'm not just moving out of the screen. So just try to work out on 2 questions and answer me. So the questions is number 1, which month will be relevant? 1 month forward or the spot quotation here? And which rate will be taking to cancel the contract? Will it be the bid rate or the ask rate? Now, I think I've got some kind of a reply here. Let's see. Bid rate, 1 month forward. Absolutely right, Mr. Mankad. You are on the task, on the right this thing. So great. Fine. And 27,000 is the loss because the amount is same. Okay. So great. Wonderful. So I think you have followed. So it tells me, that shows that, what I explained, you have followed it. Okay. So let's talk about another question. So then after this question, there'll be a similar type of a, repetition of, question I will be asking. So be prepared for that. On 15th of January 2015, you as a banker booked a forward contract for $250,000 for your import customer, deliverable on 15th of March 2015 at 65.34. So on 15th January 2015, you as a banker booked a forward contract for 250,000 for your import customer. Now you are an importer. Okay. So you as an importer, you're going to buy a forward contract and your banker is going to sell a forward contract to you. Deliverable on 15 March at 65. On the due date, the customer requests you to cancel. So he comes on to you on the due date, bang on the due date to cancel the contract. On this date, the quotation for US dollar in the interbank market is as follows. Now the rate is given interbank market. Remember that. This is the spot rate and this is the April and May forward rates. Now here, since he has come on the due date, the spot rate becomes better. We don't have to look at the forward rates here. Assuming that the flat charges for cancellation is rupees 100 and exchange margin is 0.10, then determining the cancellation charges payable by the customer. Okay. So he has come on the bank on the due date and he wants to cancel the contract. Okay. Now, since he wants to cancel the contract, he'll be charged 100 rupees flat, and then exchange margin is 0.10. So let's understand. So on 15th of January 2015, import customers bought forward contract 2,40,000 deliverable on this day. So the rate will be 65.340. Okay. Now on due date, the customer, that is 15th of March, to the request you to cancel. Now interbank spot rate on that particular date is relevant. Okay, we'll forget the forward rates which are given in the question. So the rates are 65.29, 69. Now here he has bought the forward contract. Now he's going to sell the forward contract. So he's going to sell. So it is the bid rate which will become relevant for, not the ask rate. First he has bought, now he's sold. So the contract will get cancelled. So since an importer, you have to buy a forward contract. Since you have bought the forward contract, a 3 months forward contract, now you're coming to the bank and say that I want to cancel it. So that means you have to cancel the contract by taking a reverse of the original contract. Now you're going to sell the forward contract. Okay. And the rate relevant will be 65.29. But these are interbank rates. So first you need to convert them into merchant rates. Okay. Fine. So interbank rates is 65.29 less exchange margin, which is point. So you calculate this. So because this we are taking which rate? We are taking the bid rate. Okay. So bid rate, we minus the margin. I have explained the logic that because the bank is going to, reduce the margin because they are going to, take the rate as 65.929 and they have to earn a margin on that. So that will be 0.06. So, so that means the bid rate, we have to lower the margin. So that is 65.2247 and then rounded off to the Indian nearest multiple will be 65.225. So this will become the merchant rate. Okay. Now we look at this and see the difference. The customer bought at 65.34. He's basically an importer. He's going to buy first. Okay. Then he's going to sell because he doesn't need any more of this contract. He's going to sell, which is the interbank rate, which is converted into merchant rate, which is 60.2250, which we calculated here. Okay. So the net amount payable by the customer will be 0.12. So he bought it at 34. He sold it at 0.2250. So he's making a loss of 12 paisa. So per contract, so that means 0.12 into 2,30,000. So will be 30,000 rupees is going to lose and he has to pay to the bank and flat charges 100. So that means total cost will be 30,100. Okay. Now quickly, this is the question. So I'll just give you a couple of minutes and then answer me this question. First of all, what will be the relevant rate as per this question we'll be taking? So I just made it very recent. It's 15th of January 2024. That was an old question. Okay. And so the spot rate is given to you and the forward rate is given to you and similar type of settings you need to cancel. So which rate is applicable first of all? And then what is the interbank rate and what is the merchant rate? So please do calculate and what is the loss. Just try to see what you can calculate hurriedly. Do that and just let me know the answer. And then we move on to the final topic very soon. So it will take another 10 minutes to finish off everything. So I'm just giving you another half a minute to answer it. Then I move on to the last topic of the day. Okay. Okay. So I'll just wait for your replies because the time is limited. So I need to move. Okay. So I have just now, it can be a late extension. I said the extension can be late, but there are special rules for late extension. In case of a late extension, current rate prevailing on that rate of delivery shall be applied. However, before this, the delivery, the provision of automatic cancellation shall be applied. So this is one more thing that's very important. There are FEDI rules which are applied if the customer comes for late extension. Okay, that means he need to cancel the old contract and go for a new one. So as per FEDI rules, a forward contract which remains overdue without any instructions from the customer on or before due date shall stand automatically cancelled within 3 days after the maturity date. So remember that earlier the period was 10 days, now it has been reduced to 3 working days. So the rate which is applicable on the day when the bank cancel the contract, because you have not gone to the bank on the due day and the due date has gone by and you woke up late, say on the 8th day or 9th day or 4th day, the bank is going to take an action immediately. On within 3 days, they're going to cancel the contract. Okay, and you have to pay. The contract will be cancelled on that date on which the bank has actually cancelled. Okay, so I'm just going to move out from there and let's move to the last topic, which is called the Nostro and Vostro account. Okay, let me just see whether I have got a reply. So I think you're still working. Okay, so let's go on to that Nostro, Vostro, and Loro accounts. Now, interbank transactions, foreign exchange is transferred from one account to another and from one center to another. Therefore, the banks maintain 3 types of current accounts in order to facilitate quick transfer of funds in different currencies. Now, the banks, they are actually helping the trade to happen. So they need some accounts. Okay, so the Nostro, Vostro, and Loro accounts, therefore, the banks maintain 3 types of accounts for the customers in order to facilitate quick transfer of funds in different currencies. And they are called Nostro account, Vostro account, and Loro accounts. So let's talk about first Nostro account. A bank's foreign currency account maintained by the bank in a foreign country and in the home currency of that country is known as Nostro account. So, okay, let's look at this definition more carefully through an example so you'll understand. Suppose you're a customer and let us say SBI Bank wants to make and receive payments in US dollars in US. Okay, now we are talking at account from the banker's point. Okay, so let's say State Bank of India wants to make and receive payment in US dollar in US. Okay, they'll have some customers who will be taking forward contracts, who will be requiring some money to be transferred to another this thing in America in dollars. So the bank must have a account in USA in US dollar. So for this transaction, SBI Bank will tie up with, say, Citibank in US. Citibank US will act as a representative or a corresponding bank. SBI will have an account in Citibank US. Its US receipts and payments will happen from this account. So this account of SBI India in Citibank US is SBI's Nostro account and Citibank's Vostro account. So in fact, Nostro and Vostro account are same thing, but relevant from different angles. So SBI Nostro account, or which will be also called Vostro account of Citibank. So like, let's take an example. SBI is a bank which is having a Nostro account in Citibank in dollars. Okay, SBI has opened a current account with Citibank in US dollars. In USA, this is called the Nostro account. Okay, so this is called Nostro. So all transactions which are happening, all the customers who are dealing with the bank SBI and their money is being received in dollars or they're paying out. So that account which SBI maintains with Citibank in dollars is called the Nostro account of State Bank of India. Okay, and Nostro account is referred to as Bank X to refer as our account held by Bank Y. Okay, Nostro is a shorthand way of talking about our money that is on deposit at your bank. The Nostro account is a record of banks that has money or deposit in another account bank. These accounts are often used to simplify settlements of trade and foreign exchange. So this is just the simplification of trade. Vostro account is term used by Bank Y, where Bank X money is on deposit. Vostro is reference to yours and refers to your money that is on deposit with our account. So if you look at Nostro account, are 2 different terms used to describe the same bank account. The terms are used when one bank has another bank's money on deposit, typically in relation to international trading or other financial transaction. Okay. Nostro comes from the Latin word ours. Okay. And Vostro comes from the Latin word yours. Okay. So, and the Loro account, which is when a domestic bank uses the account of third-party banks. Suppose there's a bank which doesn't have any Nostro account, so they may need the help of another bank, Nostro account, okay, which hold a Nostro account to settle the foreign exchange transactions. These types of account transactions are included under the Loro account. So let's take an example. HDFC Bank has an account with Citibank. Okay, So SDFC has a Nostro account with Citibank, but IDBI doesn't have a Nostro account with Citibank. IDBI has to pay the bills of imported machinery from USA on behalf of the customers. So IDBI Bank approaches SDFC Bank and asks to settle the invoice on their behalf. So SDFC Bank worked as an intermediary between Citibank and the IDBI. So here the IDBI will say that we have a Loro account and not a Nostro account. Okay, because since SDFC is having a Nostro account, so since IDBI is using the account of SDFC, so IDBI will say our Loro account. So in fact, they don't have a direct relationship with the bank, but all the transactions they're using of somebody else's bank. Okay, so important concept. So there are two very important concepts: exchange position and cash position. First is every time the bank is going to assess what is the exchange position, how many transactions they have happened in the foreign currency, both for purchase as well as sale. And the second is a cash position. That means how much has hit to the bank. Because if the bank has sold a forward contract, or purchase a forward contract, the transaction is not going to happen immediately. It is not going to happen and hit the Nostro account on the same very day. It may happen after some time. So cash position and exchange position are two very important positions which the banks monitors. So let's talk about the exchange position. Balance of aggregate purchases and sales made in foreign currency. So it talks about how much purchases and how much sales you have made in the foreign currency of a bank. It includes both spot and forward transaction. The transaction for which the bank has agreed for firm rate, firm commitments like draft issued. Okay, so this is the exchange position. So the bank works out every day. The exchange position is worked out every day, so to ascertain the position of the bank and that particular currency, and whenever a remedial measure are needed, they can be taken. Okay, so bank would like to know, what is our exchange position, whether it is favorable or whether it is, against them, whether they have taken an overhead or underhead. So they are going to take a remedial action depending upon the bank's own policy to see how much risk they can take. Okay, to mitigate their own risk. Now let's talk about the sources for the bank for purchase of foreign currency. First of all, banks can either purchase or sell foreign exchange. So payment, this is the source. Okay, fine. So this is the inflow of foreign exchange. How much money the bank is payment, purchase of DD, travelers checks, etc. So that means they have purchased the DD traveler checks. Suppose I am having a traveler checks of $1,000. I go abroad, and the bank purchases from me, so bank is going to get those $1,000. So this inflow of foreign currency in their account when they purchase the DD or traveler's check. Then payment of bills. When a bank is making a payment of bills, okay, export bills, so the foreign exchange is actually coming into the account. That means you're purchasing export bills, you're buying the export bills, so you're going to get the money in your account. Okay, that is a source. Then forward purchase contract. If the bank says that we are going to purchase a forward contract, okay, with export customers, then this will be an inflow into the bank's account. So they're going to buy foreign exchange. Okay, entered in the position on the date of purchase. The moment they enter the transaction, it will be entered into the exchange position. Okay, that means they have purchased. Okay, so this is the inflow. And what will be the outflow? Issue of DD. When the bank issues a DD, a foreign DD in dollars, pound, made a telegraphic transfer, traveler checks. So they have actually sold their dollars. But if they give it, a kind of they sold a DD or they have sold a prepaid card. Like, when you travel abroad, nowadays you can buy a card, okay, where you can, buy some pounds or dollars from them. So they will get, into your account. The money will come to the bank immediately, but there will be no outflow happening on account of basically in terms of money. So that will happen only when a person goes abroad and uses those prepaid cards. So similarly, avenues of sales are they have actually sold dollars to you. Like when I just recently went to England, they sold me £1,000. Okay, so that is a sale which has happened because they've given me a traveler check or a prepaid card. Payment of bills, imports. Now, which means that they say that we are going to make a payment of a bill. So this is basically a sale for of imports. Like they have sold bills in terms of they made a payment for their sold foreign exchange. Forward sale contract with the importer. So this is also entered on the same day in the exchange position. So this is an outflow of foreign currency. These are all outflows of foreign currencies, like they issue DDs, TTs, they agree to make a bill, import bills. So this is all flow of foreign currency from their exchange position or cash position, depending upon when they are going to hit the Nostro account. Similarly, the forwards account. So a cash position, it's an outstanding position. It's a Nostro account itself. When the position actually which is going to affect your bank affected only when the actual delivery has taken place. All transactions affecting cash position will be affected. Exchange position, not vice versa. Which means the cash position, all the positions which are affecting exchange position may not hit the cash position. Because if you have issued a forward contract, it's not going to affect the Nostro account at all. Only when on the relevant due date, when actual transaction happens, it may in fact affect your Nostro account. Okay. So let's talk about various situations. TT, bank draft, and forward contract. So let's talk about forward contract, TT. So TT, when a bank issues a TT, the both exchange position and the Nostro account may impact immediately. Okay. So you are maintaining two positions in your for controlling your foreign exposure to the bank. So both the positions are affected immediately. Fine. Bank drafts. The bank draft or a demand draft is handed over to the buyer who send it to the beneficiary. Now, suppose I go to the bank and buys a bank draft for say $1,000. So the bank has issued the bank draft. So exchange position has affected immediately. They know that the bank has made a draft for $1,000, but the cash position has not affected. Only the bank draft will be realized. When I take the bank draft and go to say England and give it or send it by post to my customer, and then supplier, and he honors that in the bank, then it is going to affect my account, the Nostro account. Forward contracts, again, exchange position immediate, whereas cash position is not immediate. It happens only on delivery. Okay. So forward telegraph profit transfer, DD purchase, bill of exchange. So forward TT, again, cash position not immediate, exchange position immediate. Because here it's a forward TT. So the bank is saying that we are going to make a TT after 2 days, after 10 days. Okay. So the exchange position is immediate. They know that this much of money they have actually transferred. But the money has not hit the bank account, the Nostro account. It will happen only on the day when it is going to be, the actual treaty is going to happen. So DD purchase is again the same thing. Exchange position immediate, cash position not immediate. Okay. So I'm just going to do the one question to finish off this. Suppose you are a dealer of a ABC Bank. On 20th October 2023, you found that balance in your Nostro account with XYZ Bank in London is 65,000 and you had an overbought position of 35,000 pounds. During the day, following transactions have taken place. Okay. So these are the transactions which have happened. DD purchased a bill on London. So all are in pounds, sold a forward TT, forward purchase contract cancelled, remitted by TT, then draft on London cancelled. So various amounts are given. What steps would you take if you are required to maintain a credit balance of 7,500 in Nostro account and keep an overbought position of 7,500 in pounds? Okay, so let's do this question. And while I explain the question, I'll give you all the details about what is written here. So first we talk about the exchange position. Okay, so on 20th 10, you had an overbought position. So you make a exchange position. So you have actually, purchase of pounds and sales of pound and particulars. So open balance overbought. So that means you have purchased, you have purchased 35,000 pounds. You start with this. So you have an overbought. You have a purchase of 35,000 pounds. Then the first, you purchase another DD. You purchase a DD, that means you're going to get 12,500 pounds in your account. Okay, not immediately, maybe later, but because then the DD is actually, get honored by the bank. So 12,500 you have purchased. So that means you have purchased a DD from someone, 12,500 pounds. So it has come to you and your account will be credited only on the due date, on the day when actual transaction happens, when, so you purchase 12,500. Then purchase of bill on London. You have purchased another bill on London. So since you have purchased a bill on London, it is going to increase your, position in pounds. So that means you have purchased a bill of 40,000. Okay. Export bill means, okay. Then sold a forward TD. When you sell, that means the sale of pounds. So it is going to reduce. Then forward purchase contract cancelled. So you entered into a forward purchase contract earlier. When you entered, it was coming in purchase. Now you have, it has been cancelled, it will go to the sales side. It will reduce your burden on pounds. Then TT remittance. You have given a TT remittance. That means you have made a TT, so it is going to affect your exchange position. So it is going to reduce your pound position. Then draft on London cancelled. So you issued a draft. When you issued, there's a sale of dollars, but now that draft has been cancelled. So your position will improve in terms of pounds. That means if you will have an overbought position of 15,000. So that means if you just total them both the sides now, so you have a closing overbought position. So that means you have bought more pounds than what you have sold. How much? 20,000. But the question says that you have to keep an overbought position of 7,500. So it's not matching at the moment. Okay, along with the question. So, but before we move further, so let's do the cash position and we'll come back to the exchange position later. So on 20th of October, you found balance in your Nostro account is 65,000 credits. So now it's coming green, which means that you have 65,000 pounds in your account in Nostro. Now, all other things except the TT will have an immediate effect. So it is going to reduce your balance. Okay. Whereas, DD purchase, bill purchase in London, sold of forward TTs, they're not going to affect your, cash position immediately. If you look at all the transactions, except one transaction is going to have an immediate effect on your cash position. The rest of the transactions are futuristic in nature. So they're not going to impact your Nostro account. So that means your closing balance will be 27,500 pounds. But you're required to maintain, look at the bottom, you're required to maintain a credit balance of 7,000. So the credit balance is 27,000. That means you have to make a spot sale of pounds. So you do one transaction to make the criteria, fixed by the bank that you should have 7,500 credit balance. So you sold some pounds, spot, you sold some pounds. So 20,000 pounds. So the moment you sell 20,000 pounds, your closing balance will go down to 7,500. So you have achieved the Nostro balance account as per the position or strategy of your bank. But now coming back to the exchange position, since you have sold, it is going to impact your exchange. So you will have, a kind of a nil position. So that means if you see the purchase account and the sale account, they're identical. But the question says that you have to have 7,500 overbought position. So forward purchase contract of pounds in interbank market. So you need to purchase the pound, but not now, but forward contract. The moment you enter a forward contract, it's not going to affect your Nostro account, but it's going to hit your exchange position, which will make your position as per the bank strategy to have a overbought position of 7,500 pounds. So if you look at to maintain a cash balance in Nostro account, a 7,500 you have to sell in the spot market and 20,000 in which will bring the overbought position to nil. Okay. Since bank requires, so I'll just read it, to maintain a cash balance of account at 7,000, you have to sell 20,000 pounds. Okay, fine. In the spot, which will bring the overbought position to nil. Fine. Then, since the bank requires an overbought position of 7,500, it has to buy the same in the forward market. So the moment you buy, your position will be maintained. So that is all. Okay. Thank you so much. So I now will, invite. Okay, so there's a question by Virat sir, why to enter in purchase draft on London cancel? Now, when you issued the contract, the draft, okay, so you have purchased it, okay. So let's go back to the question and see that. Purchase draft on London cancelled. So purchased, forward purchase contract cancel, purchased draft cancel. Now, when you issued the draft, whenever just try to understand whenever you go to the bank and purchase a draft in pounds. Suppose you went to the bank and you said that I need a draft of 15,000 pounds because I have to make a payment to someone. Okay, so you are basically an importer and you went to the bank and bought a draft. Okay, 15,000 pounds. So bank, where they'll enter in the exchange position on the sales side. They have sold 15,000 pounds. Okay. But the next day you came running and said, I don't need this draft. Please, sorry, because I did a mistake. I need to cancel it. For whatever reason. So they will take your this thing, draft, and cancel it. So they will just enter it on the purchase side. So earlier they had issued the draft, it went to the sales side. Now they are canceling the draft. So that means you don't longer need this the draft any longer. So the draft will be cancelled and it will be entered on the purchase side. They have sold, now they have purchased it back. Assume that it's a cancellation, it's a contra entry which goes off from your purchase and sale. I hope you have followed that.
ओके
Okay, sir.
अशोक जी मेरा आईपैड शेयर कर दीजिएगा. ओके.
So now I'll ask Ashish to take over and for the international financial management.
Sir, just if you desire, you can switch off your camera, sir. But be share with us. Okay.
I'll be there, so I'm just coming out of the camera, so I'm just for just a few minutes I'll not be there, so I'll join say after 10 minutes. Okay.
Okay, no problem, sir.
Okay.
अशोक जी हम राइट दे दीजिए मेरे को शेयर का हो गया. ठीक है. Okay, students. Now coming to this next topic, that is international financial management. I will take up this session. And in the previous session, Parvesh sir has covered the topic of foreign exchange exposure and risk management. Now, student, if we talk about this topic, of course, once you have gone through the topic with the foreign exchange exposure, this risk management, then this topic will not be that much cumbersome for or complicated for you. So let us start with discussing with the topic. If you have any query, you can ask during the session. Okay, just let me on my chat box. Now, student, when we talk about international financial management, basically, if we say that it is basically a combination of two topics, one is financial management, another is foreign exchange. Okay, now, when we talk about foreign exchange, because if we talk about globalized world, like in earlier topic, the discussion was concentrated around remittances. You can say it is kind of a transaction exposure, translation exposure, and economic exposure, because you have moved out from the boundaries of the countries. Now here, what happens when we talk about international financial management? Same thing happens, because well, of course, now that we can say transactions are not limited to export or import only. Now the companies are moving outside, even foreign companies are coming in India. So now in here, the concept of foreign exchange plus financial management means international financial management comes into the picture. So now when what happens, because now a company can have a many subsidiaries, like a company may have a ABCD worldwide, anywhere in the world. Okay, but when we cross the boundaries, there are some challenges along with the benefits. Challenges also comes with it. First of all, there are main risk is the foreign exchange risk. Now, when we talk about the foreign exchange risk, what exactly is that we have discussed? Okay, because what happens when a company is establishing or making investment in the project of in any project in outside their country. So what happens? Whatever making they are investing, first at the time of making the investment, they are having a exchange rate risk. Once they are coming out in their investment, or they are getting out back their returns in the form of profit or royalty or dividend, they are also exposed to the foreign exchange risk. So due to this, what happens? We say they are exposed to political. Now next is the regulation and a political risk. Now when we talk about the regulation and the political risk, because you are exposed to the regulations of the other country, you may have your own rules, regulations, but other country may have their own rules and regulations. So that also poses sometimes challenges, and that has been covered in the briefly in the chapter number 2 of the risk management. Now then is another topic that is export cannibalization. Now student, what is export cannibalization? Export cannibalization basically means, suppose if you are exporting some goods to any country and later on you establish a project there. So of course, now you will no more make export to that country, and ultimately what will happen? Your export will be zero, but however, you will get the profit from establishing the units. So this is called export financial. So when we talk about the financial management, it has basically, as usual, finance. When we talk about simple plain language, financial management, how to raise funds, okay, capital budgeting, working capital management, and dividend. So these are the four basic decisions under the financial management, simple financial management, that we have covered in our intermediate level. Now, when we include the international aspects of the same, then it comes the how to raise the fund from outside. Okay, it is not the raising the fund from the India. It is a raising fund from the outside India. So in this case, there are some instruments like ADR, GDRs, okay, foreign currency, convertible currency bonds, okay, foreign currency convertible euro issues, means you are not issuing the bonds in your own country, you are issuing the outside your country. Then there are capital busting. Now it is one of the very important topics, and most of the questions are concentrated around the same. And further, in this type of a question, the concept of interest rate parity and purchasing power parity comes into the picture to find out the applicable rate. Now, then it comes the working capital management. In working capital management, generally, cash management and netting and treasury management. These are three important aspects, because normally other aspect of working capital management like inventory management, etc., they are generally settled at the local level. So they are not pose that much of issues, but generally netting, that I will discuss later on. What is exactly netting? That is now, so far as the dividend decisions are concerned, these are generally related to the taxation aspect also, because sometimes we have to go by what are the provisions for the dividend declaration, etc. So these are generally tax related issues are there. Now, when we talk about the uh, how to approach the evaluation of a foreign currency project, the overseas projects. So there are two approaches: home currency approach, okay, foreign currency approach. In a home currency approach, what we do, we basically convert all the related cash flows into the home currency and apply the discounting rate. Okay, very simple. So here we can see, first of all, what we do, we estimate the cash flows from the foreign currency and that get them converted, and we exchange estimate the future rates using purchasing power parity and IRP. Then we convert them into home currency, and after that we use the domestic required rate of return. That is more important, very important. Okay, now next method is foreign currency approach. In this, we estimate the foreign for cash flow in the foreign currency, okay, and convert this domestic into, and what we do, we convert the required rate of domestic rate of required rate into the, I say I use another color, then it will be visible to you. Yes. Now here convert domestic required rate of return into foreign currency. Now what we do, instead of converting the rate, what we do, we convert our domestic required rate of return into the foreign currency required rate of return. Okay. So then what we do, we have a foreign currency cash flows in the foreign currency. Accordingly, we use required rate of return in the foreign currency, and we discount it free cash flows using the whatever the cash flows using the discount rate, and then compute the NPV. Now what we do, if we apply this NPV, we convert NPV using the spot rate. It is very important. We should use a spot rate. Then this figure and this figure will be equal. Okay, I will show you by one way of example. So don't worry, it will be shown. Now next is a adjusted present value approach. Now in this approach, what happens? Generally, what happens? It is generally also used in our some other topic also, where we can say it is kind of a separating the financing effect and separating the from the operating effect. We can say that sometimes what we do, we assume that, uh, or generally what happens, sometimes separate loan rates are there for the foreign currency projects. Even sometimes government provides a subsidy. So what we do, we say that plainly we shall first of all, we shall use base case NPV. Okay, simple base case NPV, assuming that our firm is a total equity finance. Then what we shall do, we shall consider the tax effect or tax benefit of the tax that you can say interest impact or subsidy impact separately. So by this, what we are doing, traditional NPV, we have assumed that the project has the same risk. 1 second. One second. Yes. What happens generally in a case of traditional project, we assume that the project has the same business risk as the current has. The debt equity ratio for the project shall remain the same. So it is a generally assumption. But however, what happens when we use present value, a adjusted present value, because this is based on the approach where we differ. Okay, we decipher the financing effect and the operating effect. So here we use the base case NPV and we use present value of tax benefits from interest, subsidy, and their benefits. But very important, whenever we have to calculate present value, it is very important to note that we shall use the pre-tax cost of debt. Please note it that generally student got confused in the same. We have to use pre-tax cost of debt. Now, then there are questions on the ADR, GDR. Now, ADR, GDR basically kind of a American deposit receipt. When a Indian companies are issuing, you say they are not directly can issue the shares, because what happens when any country company say, I just take an example of Indian company. Now, when sometime what happens, an Indian company wants to list their share in the New York Stock Exchange. So what a problem is that, we can say challenges are that there are stringent requirements of the SEC, that is Security Exchange Commission. So what the Indian company do, they avoid, and say investors in USA are interested to invest in India. So what they do, they normally use some custodian bank who acquire the share on their behalf and issue them receipts. So this generally, that is why it is called depository receipt, because deposits have been the money in some custodian bank. Similarly, global depository receipt. So any issue, say if a company wants to issue, any German investor wants to invest a share in the Germany, so they can go for what they can do. They can issue the shares in the Germany. You appoint some custodian bank who will acquire, who will get the money from German investors, and will this bank will buy the share of Indian company and will issue the receipts to the German investors. So German DDR mainly other than American, and American means American. Okay. And generally what happens, it is generally more than one share. It is very important to remember. Now next aspect that is related to international financial management comes is netting. Nowadays, as I told you, some a big conglomerate may have a subsidiaries all over the worldwide, and they may have a transactions among them. So what happens if they start settling the transaction on individual basis? Of course, the exchange rate risk as well as transaction charges will be there. So to overcome that, what they do, they mutually settle the transaction. Now this you can even get from an idea from the slide or my previous lectures. I have taken the case, very simple case of a company, MNC, which have a 4 subsidiaries: France, Germany, UK, and this. Now you can see that there are so much. There is a, you can say, net, or you can say there is a structure, or you can say net of what are the so many transactions are there. Now, first of all, when they start settling this transaction with each other, okay, so these transactions are reduced like that. Okay, now when we again we settle the transactions, so ultimately next structure comes like that, and last, if we do like that, the structure comes like that, and last, ultimately you can see This is a final picture after some settlement. Okay, and here this was our original. So basically, this is called multilateral netting because it is here. There are two type of netting. One is bilateral netting, another is multilateral netting. Bilateral netting means, suppose if I want to pay you 100 rupees and you have to pay me 200 rupees. So what you will do? You will pay directly 100 rupee to me because by bilateral netting. Now here multilateral netting means there are more than one companies are involved. Okay, student. Now, if you have any questions, so that I proceed to the assignment discussion quickly.
Please go ahead, sir.
Okay, thank you. One second, I can plus. Okay, student. Now this is the first assignment. Is it visible or not? Yeah. Okay, now here it is first assignment and question number one. It is a very simple question where we have discussed the home currency approach and foreign currency approach. Here I'm just briefing you a question because assignments are with you and also we have discussed in the previous lecture. Now here what is happening? DK Limited is considering investment proposal with home currency approach and foreign currency approach. I can briefing you a question because assignments are with you and also we have discussed in the previous lecture. Now here what is happening? DK Limited is considering investment proposal with home currency approach. शुभ जी मेरी आवाज इको हुआ था इसमें कुछ तैयार है ओके now student here what happens DK Limited is considering an investment proposal in Sri Lanka अच्छा ओके ओके okay. Now DK Limited is considering an investment proposal in Sri Lanka involving an initial investment of rupees Lankan 25 billion. Okay. The current exchange rate has been given. Okay. Risk-free rate of return has been given to you. Now this risk-free rate of return and both in countries have been given to you. So it is somewhere giving you a hint that we can say it can be used for evaluating computing the foreign exchange rate risk in the future period. The project will generate a cash flow of Lankan rupee 5 billion in the first year. The cash flow will increase by Lankan 1 billion each of the next 4 years. The project will wind up. I think it was got wind up type upon on the completion of the 5th year and with no salvage value. The required rate of return of the project is 8%. Now, even it is a domestic. Okay, now we have to use investment worth by project with both approaches, home currency approach as well as foreign currency approach. So PV factor table has been given to us. Now student, it is a very common doubt. Is up to what decimal point we have to use the PV factor in the examination. Student, if present value factor table have been given you in the examination, so please follow it religiously. Okay, don't use any other option. Now if nothing has been mentioned, so better option you use up to PV factor up to 3 decimal points. Now when we start working on the same, working notes are there. Okay, so first of all, in first part, we have calculated applicable foreign exchange rates because this will be used for the future period. So I not need to repeat. Here we have used the purchasing power parity. Then when we apply the home currency approach, so what we do, these cash flows are in Lankan rupees. Okay, we apply the relevant rate and we get it converted into the home currency and apply the present value factor, that is the required rate of return from the domestic point of view. So simply we are getting the answer of NPV of 1.126 billion rupees. Okay, now come to the foreign currency approach. Now, when we talk about the foreign currency approach, what happens? We have to be very conscious one. First of all, the required rate of return, that is 8%, was from domestic perspective. Okay, so we have what we have to do. This is a risk-free rate of return. So we shall have to compute what is the risk premium, or we can say it is a kind of a risk, pure play risk premium for a project applicable. Okay, this is a pure risk-free premium for a project applicable. So first we will compute the risk premium, and this risk premium comes 7.8%, say 7%. True. So we can say somewhere it is around 7%. We require a return from a project. Now what we do, we compute, we use this rate. Sorry, it was a risk premium was our sorry, it was somewhere 1.887. Okay, you multiply it with the risk premium rate. Sorry, risk free rate of Sri Lanka. This is a risk free rate of Sri Lanka. Okay, by this we get the value, the rate of return, required rate of return in foreign currency. Okay, now here we use what we use. These are our years. Now here we have discounted. Now you see here we have converted. Here we shall not convert the same. Okay, so we shall apply cash flow. These are rates are those are there. Present value factors are there. Okay, we multiply the same. We get the present value, and from this when we deduct the investment, so we get this net investment value. This is basically in Sri Lankan rupees. Okay, now if I apply this spot rate, please note that here this is spot rate. Once again. Please note it, this is the spot rate. So we get this amount of NPV Indian rupees. So you see here, this is a very small difference. Someone it is nearby. Okay, student. So I hope it is clear to you how we have computed the same figure by just nearby using the home currency or foreign currency. Now question is sir, in the examination, which approach we have to follow? Say if it has been mentioned in the question, you have to follow this approach. Please follow this approach. Otherwise, if you use any approach, please you can solve by only one approach. You will awarded the marks. Unless and until there is some hint, that have to be careful, because sometimes they may give some hint. If they does not give you any hint, so you can follow any approach and answer the question. Similarly, in my earlier notes, I have discussed alternative solution with question number 1 using the domestic currency approach of the study material. So you can refer it from the recorded sessions. You will understand easily. Now I am coming to the second question. Okay, so second question is basically from, you can say, somewhere study material. So I'm not repeating here. Okay, so just I'm coming to the next question. Only one point is that here I've made some slight modification that they will not get any tax credit for the withholding tax. So accordingly, you have to pay the balance tax of 20%. That is a more important point in this question. Now this question has been adopted from our earlier examination. It says a company wants to set up a manufacturing plant in India and requires an initial investment of 8 million. it is expected to have a useful life of 5 years and with a salvage value. The company is following the straight line method of depreciation to support additional level of activity. The investor requires one-time additional working capital of 1 million. Since the cost of production lower in India, the variable cost of production would be 30. Additional fixed cost per annum is estimated rupees 0.5 million. The company is projecting its annual sales of 80,000 units at a price of rupees 100 per unit. Applicable rate for the company is 34%. Cost of capital is 8%. Inflation rate in US and expect are 8% and 9%. So it gives an indication that here there will be use of purchasing power parity. The current exchange rate is 72. So there will be no issue. Assuming that the profit will be repatriated every year and there will be no withholding tax, estimate the net present value of the proposed investment in India and evaluate its feasibility. So student, here again the present value factor has been given. So that will not pose any problem. So first of all, as in your simple capital budgeting, we determine first initial investment. Okay, we can say it is at a period 0. Okay, now here initial investment. Now we compute before computing any expected cash flows. And a home currency, it is always better you use the expected foreign exchange rate. So here we are using purchasing power parity because inflation rate has been given to us. Okay, accordingly we computed it, and after computing we have computed the annual cash flows. Now since the company is basically a US company, they will get converted into the foreign they will get converted into the US dollar. So okay, now first what happens, annual cash flows we compute that are computed in Indian rupees. This is sale, this is variable cost, additional fixed cost, and of course depreciation, and simply we compute the tax and add back the. So it is a basically very simple calculation of cash flow that you have done at your intermediate level. After that, what is the only additional step if we see from our intermediate level and final level? Here we are using the present you can say expected forward rate, and then we are converting into the US dollar. So this is the cash flows are in Indian rupees. Okay, they are used by applying the expected foreign exchange rate. So these are our expected cash flow for the coming 5 years. Very simple. Okay, and it is very important to remember that there will be a release of working capital, but here our rate of release of the working capital will be applied what is expected forward rate. Please remember, when we have invested working capital, the rate was spot rate, but when it is released, of course it will be forward rate. Okay, so it will be the release of working capital in dollar. Okay, last the salvage value, again that will be in the dollars. We have converted forward rate. So overall, this will be our NPV position. Very simple, not a problem. Because in this question, see, whenever we talk about a topic of the international financial capital or financial management, and especially capital budgeting questions in under it, very simple logic, all things are given, only just you have to apply basic discount rate, cash flows, and just apply them. Okay, two things are computed, problem is how when. Only in additional, very important in international financial management capital budgeting is you have to calculate correctly the forward rates. Because sometimes what happens, it has been observed the student had wrongly calculated the forward rates. After that, they will have lost all the marks. Nothing will be awarded to them. Okay, now next I am coming to this question. Student, this question has also been adopted from our earlier. Abhikesh, please ask your question.
Sir, what is the logic, while calculation of forward exchange rate? As in earlier example, the current spot rate has been multiplied by a certain multiplier. One that is, I think, rate of 1 plus 8.
I think you are talking about the foreign currency approach.
Yes, sir. Earlier example, sir.
Yeah, earlier example. See what happens. basically, if you see that NPV is computed always on zero period. Okay, if you know that NPV are always computed as on date. Say I am today say investing in some money in any country. Not I am country. You forget the country. You just say as for a simple capital busting, I am estimating an NPV as on date, zero period. Is that clear, sir?
Yeah, that is true, sir. But I mean,
so that's why you see here. I show you the question, then I let this. You must be saying that this one.
no, sir. So that 1.09 divided by 1.08, I am asking. 72?
Okay. In the same question.
Yes, sir. In that USA, not this one.
Next question.
Next. The latest year, I mean, shown, sir. Your source.
This one.
I am asking about this. I am asking about 1.09 divided by 1.08. I mean, what is the logic? What is the chronology?
Okay, I just give you very small logic. One second. Now say, I got your point. You want to know what is the logic behind purchasing power parity.
Sir, you are not audible.
Am I audible now?
Yes, sir.
Okay, just a second. You want to know exactly what is the logic behind purchasing power parity.
I mean, multiply current exchange rate by rate of interest, 1 plus rate of interest, divided by 1 plus rate of interest.
Just 1 second. You are I think 1 second, sir.
No, it's the example. Here also it would be fine, sir. Here also it's the same. I mean, same.
1 second. I just give you logic. Just 2 seconds. One second. Just I'm coming. I skip this slide. Now you want to ask this now?
Yes, sir.
Yeah, only just 1 minute. And I think it is inflation rate. If I read this question, the inflation rate in India is 9%. Okay, it is in USA 9%, 8%. Okay. Now just I give you a very simple logic. Now suppose and 1 kg of apple. Okay, 1 kg of apple costs 72 rupees in India. Okay, similar category of apple cost $1 in USA.
Yes.
Okay. Now, since inflation is prevailing in both the countries, while it is in India 9%, it is in USA it is 8%.
Yes.
Okay. So what will happen? Same category of apple will cost in India at this much.
Yes.
And same category of apple in USA will cost this much.
Yes.
Am I clear?
Yes, sir.
So what will happen? What will be by forward rate? Simply.
Okay.
$1 rate.
Okay, got it, sir. Thank you. Yes, sir.
Okay.
Thank you.
My pleasure. Okay. Okay, students. So here we have what we have done. We have computed simple cash flow. Okay, we have applied a simple cash flow, and ultimately we have got this salvage value. And in the last, we have computed NPV, and it is positive. So we are accepting the project. I am coming to the next question. Now this question is basically earlier also adapted from the question. Here there is only one. Since time left is very less. If you have any particular doubt, you can email me or you can talk me over the phone. Otherwise, I'm just because all the questions are on a similar line. I will take over one or two questions on treasury management base. Here, see what happens in this question. If this question is from the early past examination, first para is very normal. It is like other question. Only this para is additional one. Okay, here this has given the decline in the value of USD in percentage term. So ultimately, reduction in the local cost of production in USD per unit. Okay, and along with we have applied given the probability. Now here the one concept that will be tested one. You can say it is a combination of two concepts. You can say it is a concept of a combination of major two concepts. One is advanced decision in capital busting plus foreign exchange. Okay, so all these aspects have been discussed here. You patiently, if you will solve this question by seeing the lecture first, don't try at your own. You will easily understand this question because here the question is bit long. We have to divide the solution into three categories. We have to divide three scenarios. Okay, if you recall that this was discussed in the topic of scenario analysis in capital budgeting. Okay, so you see here, it is basically we can say scenario one, scenario two, scenario three. So all these because here we have to see scenario. One is decline in the value of USD as a 10% or it is 15% or there is no change. So there are three scenarios. And accordingly, in the three scenarios, we have discussed the same. Okay. And expected cash because here we have to see one is depreciation. Another point is regarding the depreciation line. You need to take care of this line. The plant at a current exchange rate will have a depreciation of USD 1 million annually. And okay, and last there is one line here. Now here it means that current exchange rate. A word has been written current exchange rate. So it means if there is a change in the current exchange rate, we shall also appropriately change our depreciation. So this line, this word we can say it is very important. Okay. So student, now here we have considered the depreciation separately. Sorry. These three depreciation you see in the three scenarios is different. Okay, accordingly, now when we come to the first two parts, there will be simple analysis of the advanced capital busting and our foreign exchange. Now, when we see the third question, in the last line it says viability of the investment provider investor plan working capital investment and that no problem. The cash flow after tax will grow at 3% per annum perpetuity. Now this gives an indication of one more concept, and this concept is valuation. Okay, this gives the concept of a valuation as we have done the valuation of securities, that is share, where something grows perpetuity, we use the formula Gordon growth model. Here again it will be applied. So we can say this is a good question of combination trying over multiple concepts. Accordingly, in the last, when it says cash flow after tax will grow at this, then I think I forgot to mention this growth rate. Okay. So the value comes like this, and ultimately what we do, we determine the value of, this is value of perpetuity. This value of cash inflows in perpetuity. Okay. So this is minus, and this is initial outlay. One second. Okay, just we compute the NPV. Now this question is from your study material. Okay, you can see the solution there. Only one thing I would like to discuss in this question, very important. Here, there is a line mentioned that, see, I'm just reading first or two lines, then you will get an idea what exactly I want to convey. A multinational company is planning to set up a subsidiary company in India, where hitherto it was exporting. in view of growing demand for its product and competition from other MNCs. Now, see student, now it is planning to subsidiary in India. Okay, there is another country. So, but this country company in other country was exporting to India already. So, if they establish a plant for a company in India, so it will be export cannibalization case. Okay, it will be export cannibalization case because ultimately export will be killed. Export will be killed. So there will be no more export. So that is why it is one of the cases. And one another important very point in this here earlier it was the 2 points in this question very important. Earlier there was importing 2 million units. Now since other expected that other MNCs will be their companies, so our export will be reduced to 1.5 million. So opportunity cost we will consider 1.5 million. Now, another very important point in this, we shall use incremental growth in this question. Because from earlier to the next one, earlier we are exporting to them. Now we are setting up a plant. See, there are two cases. One, we are a fresh case. We are establishing a project or new project in another country. Now, suppose if we are a country we are exporting, now we are establishing a plant or we are setting up a plant there. Of course, then there will be two cases. First, we have to consider what should we do? We have to make incremental analysis. It is kind, we can say that if we equate with a simple capital busting decision, it is kind of a replacing of a machine. Okay, it is a simple case of a replacing case of a machine where we are replacing a machine with the improved capacity. Okay, student. So this is the simple case. Although the question is quite long, but my request to you, please solve the question very patiently. Each and every step you take care, because this question, once you take each and every step you read carefully, you will understand the question. And my request to you, at least try to 2 or 3 times at your own, because this contains so many points that every time students skip 1 or 2 points. This is a very common problem with them. Okay, now we are coming. I think it was the last question of the assignment. Yes. No, it is not the last. It is the second last. In this question, see what happens. The concept of adjusted present value has been discussed. Okay, because here there are some hints have been given, like all equity financing project at 12% per annum. Okay, so what we have done, first of all, we have computed NPV using all equity finance simple logic. And one more thing, we have been given EBITDA. EBITDA means earning before interest, depreciation, tax, and amortization. Okay, so it is that you can say it is a pure kind of a just profit, simple plain profit. Okay, so here very important to note that since depreciation we have to consider tax effect depreciation separately. Now here this question is a bit complicated because of one reason. Here the economic life of the equipment 10 years, whereas project life is 20 years. So that's why we are calculate this factor separately for 1 to 20 years and tax benefit on depreciation for the 1 to 10 years. Okay, student. So that is more important. And here, had it been the same period, then first you will do from EBITDA you will deduct the depreciation, then you will deduct the tax, then you will add back the depreciation, then you will get the cash flow. So this will be a simple cash flow case. Okay, but here this case has been complicated due to this factor. The economic life and project life of the project, economic life of the project and the real life of the project is different. Next, very important, this is our base case NPV. Okay, from base case NPV, we determine the present value of taxes and present value of the interest. Okay, so tax benefit on interest payment. Okay, so here you see our very important point. We are using pre-tax cost of debt. Why? Because see here, our post-tax cost of debt is 5.6. Okay, post-tax cost of debt is 5.6. We have to use pre-tax. So what we do, if in the question it has been given like that, pre-tax. Okay, simple. 8% has been given, then we have no problem. Okay, we just you apply the 8%. But since here it has been given, and there is another hint. Here we can see that we have been provided the PV factor of 8%. So it is a kind of a hint in the question that we are going on a correct way. Okay. The student, here you will just add the same tax benefit. You will get the adjusted present value. And now we are coming to the last question of the first assignment. Here it is a case from the your again from Amrikesh sir, please.
Sir, please go to the same. I mean, same the last question. Question text. I'll just. I want to. Want to ask about question. The figure given. Sir, here in last line where PVIFA one value is given 8% for 15 years is one thing, and in next to it is a 0.315. Why this difference when the values are same 8% and 15 years?
Here A has been additional.
Sir, last line in the question adapted from earlier CA exam, just about that.
You are saying this, na? There are two values are PVIA 8% and 15%.
Okay, that is annuity. Okay, sir. That is annuity, and there is A is not there. Yeah. Got it, sir. Yeah.
Okay, got it.
Yeah.
Okay, friends, this question is from your study material, and here there is only one very important point that I will discuss like to with you. Here it has been given in the nominal terms. Okay, so because nominal means it is inflation has been considered. Okay, it has been considered. So sometimes the question may be given real, and then you have to use the nominal. So because see what happens when you are considering a simple discounting rate, so you generally use the nominal rate. Okay, nominal, what are the nominal cash flows? So in this question, again, we have computed forward rate as usual. Okay, cash flows have been given to us, so that we have got converted. Only important point here, one is that if real has been term used, then you will convert time into the nominal rate. One very important point. Another important point, this have calculated the modified internal rate of return. Actually, basically, this topic is related from slightly from your financial management point of view. See what happens whenever we use the internal rate of return. There is very common assumption that it will be reinvested at the same rate. Okay, so here it says you have to compute modified internal rate means we have to compute. Just I show you. Just have a second. Just 1 second because this is saving in a saving mode. Now see here. Inflation rate in Nepal is 9%. Okay, the current exchange rate. So what we are doing, we are assuming that whatever will our cash inflows, that will be reinvested at the 9%. Okay, that will be invested at 9% because in India, the discounting rate is 9%. Accordingly, what we do, we assume that whatever is the cash flow that will occur in the first year, that will be reinvested for the 2 year, because it is assumed that the cash flow generally occur at the end of first year. So this will be reinvested for the 2 year. Okay, so 2 year it will be reinvested. So it will be our income at the end of 2 year. Cash generated at the end of second year will be reinvested for 1 year. This will be the value at the end of third year, and cash flow generated at the end of third year, it will be the same value, no change. So ultimately, this is called terminal value. We divide it by the initial outlay and we get it cube root. Generally, for the cube root, you cannot use your simple calculator that is allowed in your examination. So you leave the question here only. You not to worry about the same. Institute will take care of the same. Generally, what happens in case in the examination, if we found that any calculation cannot be carried out on your simple calculator, so leave the question there. We will take care of the same. Okay, so you not to worry about that you will lose unnecessary marks for the same. Okay, student. So ultimately, the answer will be 7.2. Okay, student. So with this, we come to the end of this assignment. I'm just quickly taking the other assignment. I think there is no more question assignment. Okay. Once again. Okay. Now, generally, other questions are very simple, like netting, etc. Now, here I'm just taking up the first question because that is question related to your ADR and GDR. Now, in this question, student, please see. Basically, I'm just reading out the question, then I will just brief out the same, but rest of you can do at your own. Now here, the company is expanding their operation and planning to install manufacturing plant at US. Okay, it requires 8.82 million USD net of issue expenses. One very important point. Issue oblique flotation cost to fund the proposed project. GDR proposed to be issued to finance are estimated to cost to be, it is a flotation cost. Okay, it is a flotation cost of the GDR. Next is export market, expected market price of the share at the time of issue. So this is the market price at the time of issue of GDR. Okay, now here very important second point. Each GDR will represent 2 shares. Underline that I had discussed earlier. Generally, each GDR contains more than 1 share. It can be 2, it can be 3, or it can be any multiple. Okay, so ultimately what happens? Now next is the issue share shall be priced at 10% to the market price. It is one of the very important facts. Now, of course, whatever are the market price, generally they are considered as some discount to make some adjustment. Now, expected exchange rate is INR. This is at a spot rate. We can say it is a kind of a spot rate at the time of issue. The dividend is expected to be paid at 20% with the growth rate of 7. So here we can say it is some kind of a valuation concept has come into the picture. You as a financial consultant are required to compute the number of GDR to be issued and the cost of GDR. Okay, accordingly, and next point is first we can compute first part. Okay, then we compute the second part. Okay, now when we have to compute the GDR calculation, first of all we have to see what is our size of the GDR. Of course, when we have to calculate the, we can say compute the what is the issue price. So current market price of the share is 360. Okay, of course, it will be at a discount of 10%. Each ADR will be have a 2 shares backing for the same. So ultimately, this will be the issue price. Now, this issue price will be received in the dollar. This has to be converted into the dollar. So we shall use spot rate. Accordingly, for $9, one GDR will be there. Okay, so accordingly, we can say another working note we have drafted. So what will be our dividend? And dividend will be at our say face value. Face value is 100. 20% means 20. This is 40 rupees. Now net proceeds in GDR. What we shall receive net proceeds? Let us see. Because what we are doing, issue price is 6. Our GDR is 640. Okay, and we are issuing net flotation cost is 2%. So ultimately, this is coming to our pocket. Okay, this is coming to our. So this is working notes have been completed. Although you can use you can compute later on. Now, when I talk about number of GDR to be issued, first I have to issue 9 million GDR. Of course, per GDR price is $9. So of course, I will issue 1 million GDR. Now, first part is clear. It says, what is your suggestion? Company is receiving offer from the US willing to provide an equivalent loan at 12%. Now, here we have to compute the GDR cost. Okay, what is the costing of GDR to us? So again, what we have done, we simply use, it is basically we shall compute in Indian rupees. So this much of dividend we are paying. Okay, this much of dividend we are paying. This much of this is coming into our pocket. Net of all things. Okay, whatever the flotation charges. Okay, and this is our growth rate. So accordingly, this is costing us. Now, since we are getting a loan at a rate of 12%, of course, we shall take the same option. Okay, student? Now, last is how much company can save by choosing the as recommended by you. Okay, now if I say you should go for the loan at 12%, so of course there will be a saving of 6.3% because 8 point is 12%. Okay, student. Now, this next question is another question. I think it is from your study material as well. Let me check. Exactly the question number. Just have. So this question is basically, please note that this question is basically in your chapter number 10. That is foreign exchange exposure and risk management, and question number is 49 on page number 10.65. Okay, so here this in question is kind of we can say it is a kind of a treasury type of a question where the company's bank have a London office have a surplus fund with it. Now they have a choice. Either they go for the because they want to they are the US dollar, so they want to compare whether because they want to swap some for the US pound. So although calculation is based on the pound, so what they want to know London office where we have to make the investment. Of course, there are 3 centers: London, New York, and Frankfurt. See, in the London, the investment will be made in pound. New York, the investment will be made in dollar, and in Frankfurt, the investment will be made in euro. So simply, we have been provided the interest rate. Okay, only thing is very important that there are 2 important point here. The cost of fund has been given to us. Students, please note that. This is one of the very important line because the dollar cost of fund is, we can say, it is a kind of an opportunity cost. Okay, when it is a kind of an opportunity cost, so whatever calculation we shall make, we have to consider this opportunity cost, and accordingly in our solution, if we see this portion is basically relating to. Okay, answer is there with you in the study material, but you understand this is a kind of a opportunity cost. And one more point, here we are using 1.543 rate because this is of due to conservative look. We are, of course, actual rate we can say that if we because it is basically considering conservative view, it is using the buying rate, whereas alternatively selling rate can also be considered. Okay, so accordingly, we can say that if I can use another rate 1.5475, that will also be correct. There will be no problem because we can use either of the two rates. Okay, student. So this is a one or two important point I want to discuss with you. Rest of the solution you can see and our previous lecture also. And this is one of the very important good question that I like very much. Now, student, this question is adopted from our study earlier examination. You just read the question. I will just take 5 minutes to get it solved. Then after that, I think one or more questions. Then we will find out the solution. Just you read the question. Now, in this question, it says ICL is an Indian MNC is executing a plant in Sri Lanka. It has raised rupees 400 billion. Half of the amount will be required after 6 months time. ICL is looking for an opportunity to invest this amount on 1st April 2020 for a period of 6 months. It is considering two underlying proposals, index fund and treasury bill. Okay, this investment is basically in Japan. This investment is simply in the US market. Basically, treasury bill, risk free, very important. Here it is the risk free. That is the main feature. Now, when he will invest in the Japanese market, so he will get income in the form of dividend. Okay, income from stock lending scheme. Generally, if you own the stock and you lend it to someone, it is one of the things. And here it will be loss. Why? Because there will decrease in the value of the. Actually, it is not the interest at the end of period. It is not. It is mistakenly typed here. It is make correction. It is end period. Okay, exchange rate has been given to us. That is on spot rate, and that is after 6 months. All rates have been given to us. Similarly, when we talk about the treasury bill, there is no any other. There is no such kind of a thing because of course treasury there can be a case of where the treasury bill will be redeemed at a premium or a discount. It depends on the forward rates that we have covered in our bond valuation chapter, where there is a yield curve. If the yield curve is going up, of course our income will be less because that will be traded at a discount. Because treasury bill value generally determined by the federal rate. But here we are ignoring the same. So there is no such nitty-gritties are there. Then there is only plain income, 5% per annum. Okay, this is plain income of 5% per annum. Here we have been given the rates. So of course, first we start with our what is the best for investment when required to suggest. You have to suggest the best for. First, we consider the market of the Japan. Available amount 200 billion. Okay, exchange rate we are using the spot rate. So accordingly, this amount is converted. So this amount comes here. After this, what is our income? Now see, 25% our dividend income. Okay, stock lending scheme, we have been given the income. Now, when we talk about the end value, so this value has been declined by 2%. So this is our end value. So overall, at the end of 6 months, this will be our value will be on Japanese yen, it will be the value in our hand. Now here we have been given the spot rate 1.58 and rate after 6 months it is 1.57. Accordingly, we shall apply here this rate. Okay, so the convert when we convert it on the same, so this will be our income. Okay, this will be our amount will be in our hand, and our gain will be our rupees 20.7629. It is a case of a Japanese investment. Now I am coming to the case of investment made in US. Okay, when we investment are made in US, so this amount is available. Okay, exchange rate is this. So this will be the amount in converted into US dollar, and on the interest we will get a treasury bill rate for the 6 months. So this will be my income. Of course, at the end of period, this will be amount in available US dollar. Okay. Now I will use the conversion rate here at the on 31st 30th September 2020. After this will amount will be the my ultimately amount available with me. Accordingly, I have invested this much of 200 billion amount. So my gain will be 20.792. So we can see here our both gains are similar. Okay, our both gains are similar. Now question arises where we have to make the investment. Of course, if you write the answer, we can make the investment either of any place. Again, will be the same. There is no problem. But here, slight my own opinion. You may have a different opinion, but my opinion is that this US Treasury bill is a more certain in terms of say values or interest. So we should be advised there. It is my suggestion only because of course in the answer because generally what happens in this kind of a questions, it is the answer of a student that matters a lot. If any student give a opposite logic, opposite advice, but with a strong logic, so generally they are awarded the marks. Okay, of course, if the common man will say that, oh yeah, we can make investment in anywhere because the amount is the same. But here my submission is that we can should consider treasury bill because they are kind like more certain. Okay, student. So with this, I'm coming to the last question. Of generally these questions are from your study material, and generally one more question I want to discuss with you. One second. Now see here, I'm just taking one question that will be clear to you. I think there's a second. Now here this question number fifth, and question number six on a similar line. A student, what happens? It is generally called swap investment. What happens? Sometimes a company may have a subsidiary worldwide. Okay. Now in this case, what happens? They may say that why should if they invest there in surplus fund in every MNC. So what happens? Sometimes they may say that if we invest our in our own country, they are getting the interest in their own country's currency. So what is sometimes they do? This is generally happen in case of a Western world case, Western world where the transfer does not funds does not involve that much of charges. So what they do, they try to see. I'm just reading out the question that you will have, then you will have an idea. Suppose you are a treasurer of XYZ PLC in the UK. XYZ PLC have two subsidiaries. One is based in Amsterdam, another is Switzerland. Okay, so accordingly, we can say that it is based in Amsterdam. Okay, so the investment will be in euro, and it is Switzerland. It will be Swiss franc. The surplus position of funds in the is as follows, as it does not need for the next 3 months, but will be needed at the end of 91 days. So suddenly it is given that after till 91 days we are not need of any fund. Accordingly, these are the surplus funds. Okay, exchange rate applicable are they here, spot rate as well as 91 days. Points have been given, so of course we shall compute the rate. Okay, 91 days interest rate on the per annum basis deposit money market rate are as follows. Okay, amount of the currencies. Okay, now here the slabs have been provided. Okay, here the slabs have been provided because see, as you can see, as the we can say that as the amount of it is just like of FD. Okay, As the amount are increasing, the interest rates are also increasing. It is increasing by that. So of course, it seems that as much as amount we can pool together, we will have more money. You are approached by the banker wherein the above mentioned surplus lying, requesting you to swap surplus lying in the two subsidiaries and place deposit with them. Determine the interest rate up to per annum that you should be offered by the bank to organize your organization is ready to such swap agreement. To see what happens. I'm just coming. I think there is some slight variation. Now, first of all, what we consider if we take a case that we invest separately, okay, independently. Okay, so when we invest independently, of course, in Amsterdam, we will get this much of interest. Okay, after 9 months, our investment will be this. So what we are doing, we are converting, since it is a UK company, so we are using one base, and that is base is pound. Okay, that base is pound because in the mention the question, it is a UK company. Okay, now here it is says that it has been approached by your banker where so company is basically in UK and banker is also the UK banker. So they are saying you swap the investment here. Okay, so ultimately this will be converted into UK pound. So here we have applied the UK pound rate. Similarly for Switzerland, first we have done independently, individually, and this amount has been converted into UK pound, this much, and of course there is no chance to convert UK pound, so ultimately this much of amount we have been left with, okay, at the end of the period. Now what we do, we swap just now, we swap to sterling as on date. So what is the position? See, if we sell the swap this much of pound, we shall use the spot rate. Okay, this must be our US dollar, UK pound. Accordingly, sell Swiss francs. This will be the pound, and UK pound are independent. So ultimately, this much of amount we are getting. Now, with this getting amount, you can see that here, student, if we go by the slab, our rate of interest, we will get this much. Okay, of course, there will be an increase of 1%. Earlier, if we are using independent, when we are using independent, so the rate of interest was 1%. Now it will be increased to 2%. Accordingly, we compute the interest. So what we see, this much of amount will be ultimately in our hand, okay, on a spot basis, and this will be on the individual basis. So they will say, my mistake, I do not consider 2%, but because we are negotiating with the bank, so what we do, we shall say if we invest individually, so ultimately amount coming in our hand is 20,511. So this much of amount in pounds we require. Okay, this much of amount we require in the pound. So ultimately we say if we make an investment with you, we need this much of interest. This is our investing amount. This is our investing period, 91 days. In annual term, we shall quote a rate of 4.023%. But now it has to be seen whether the bank can offer, because here the slab, which in we are now here we can see. So my mistake, we can see that here over 20 lakh they are offering in 5.38. So minimum we are asking 4 point something rate. Okay, of course our amount is since, and this here 1 second, we are, so ultimately minimum rate we will quote this much. Of course, if we get the opportunity, we should get for the investment at the 5.38. Okay, student. So with this, I am coming to the end of today's lecture. Now, I thanks Parvesh Agi sir. Abhikesh sir, please ask your question.
Sir, what that 91 days PTS points indicates, I mean, and where it is used in the question itself?
Well, 91 days points, it is, you mean to say like this?
Yes, sir, where you have marked the arrow.
Yeah. Please see here. It is basically the exchange rate. It is basically the exchange rate forward and spot. Here it is a spot rate. It is basically the forward points. Okay. Now since it is in increasing order, so these are considered as premium. It is in declining order. It is considered as discount. Okay. Now see
Okay.
here. When okay, got the point?
Yes, sir.
Or should I proceed further?
No, you sir, proceed further, sir. It's
Okay.
okay.
No, you got this point, or I because I more
No,
explained.
sir. I got this point, sir. Thank
You
you.
got this point, no?
Yes, yes.
Okay. With this, we come to the end of the session. Now, before we move, there is one quickly. I'm just sharing with you some MCQs which professor has shared with us. So just 3 to 4 minutes, we shall go through the MCQs. Then we will wind up the session. Now I think it is visible to everyone. Hmm. Now it says Alicia Jadi is an Indian traveler visiting Europe. The cost of purchasing euro at airport is rupee 1 is equal to euro this much. Okay, Alicia wants to buy 2000 euros. How many rupees she has to pay for to the dealer? Just make calculation. Then I will share the answer with you. You can send your answer in chat box.
Sir, B.
B. How you have completed?
Required euro divided by asking rate. That is the right side of the.
No. I just correct you. Can I correct you?
Yes, sir.
Huh? See
Yes, sir.
what happens? What happens? It is one very basic rule. You are right that we have here. This is the that's why Professor has done it in another way. It is basically indirect quote. Okay. Okay. Just I show you by one way of calculation. Just one second. If I convert this rate into direct quote, because this rate is for one sorry 1 rupee. Okay, it is in euro. So see
Yes.
here, if I surrender 1 rupee, okay, so this much of euro I will get. Okay, if I want to buy 1 rupee, this much of euro I have to surrender. So of course, this is on higher side. Okay, so this is called ask rate.
Yeah,
Okay.
sorry. Rate. It should be bid rate. Yeah. So it's divided by 0.01137.
Yeah, that's it. Now you're correct.
Yes.
Okay,
Yes,
so our
sir.
option will be A.
Okay.
Got it?
Yes, sir.
Now next question. Students, the forum is open for you. Even you can verbally answer the question. Very simple.
Sir, hedging.
Yeah, very good. Now next is hedging risk of for a long position is accompanied by.
B.
Yeah, very good. Now next is fourth question.
I'm not sure, but D, sir.
But
I'm not sure, but D.
D. No, your guess is correct. See, here you are
No,
going
answer
right
is
to
right.
work,
It's
but
D
you
only.
may be okay. You may be sure that because if we have a long position, suppose we have to take a short position. Okay, selling means short position.
Yes, yes.
Okay, but main point here is this because we have to take the same period, June. The time factor here is very important for the same period, June to
Yes.
June.
Yes.
Okay, and last question. It is somewhat related to your derivative topic also.
Yes, sir.
And I covered this during my lecture also. I talked about.
Maybe you have sir, but this topic is also same covered. Logic is same.
It is covered in the derivative market
The
also.
derivative market as well.
So if you understand this, then you understand the market. It's very simple. Even the fourth question and fifth question will actually make your futures concept quite clear.
But that is only for academic purpose, sir. We can't indulge. We can't encourage students to do the trading at there right now.
Definitely, but not trading. But again, because our questions are coming in the futures and options market,
hedging.
So we should have at least theoretical concept.
Yeah, certainly, sir. Application you can try, sir.
It's a mark to market.
Yeah, very good, sir.
Absolutely right. Smart.
Okay, sir.
So there is a daily settlement which is happening in the stock market, just to see that there is no default which happens. Okay.
Yes.
Because only at the end of the last expiry, only the last day, amount is exchanged.
Yeah.
So all the settlements happening every day. Okay.
Every day. Okay, sir. Thank you very much for
Thank you, sir.
Thank you.
Any student can raise a query, and because Pravesh sir is still with us. So with this student, we come to the end of the two important topic. One is foreign exchange exposure and risk management, and another is our international financial management. Of course, if you have any query, you can contact us through the mobile app. Okay, you can send us the email. Okay, I'm writing down here our telephone number. Okay, our email ID. So, student, thanks a lot for making this session very interactive. Now we shall come up with another revisionary class for the next topic in the next class. Okay, till then, just go through the recorded sessions, and it will be very helpful for you to attend the next class. Thank you, Pravesh sir.
Thanks a lot. Thanks a lot for
Shogji, thank you.
Thank you.
Okay, bye.
Bye. Have a nice day.
Sure. Same to you. Thank you.